Good morning, everyone, and welcome to InvestorExpos show for July 16th. My name is Anna, and I'll be your host today. We are having a great lineup of 4 speakers for you. For the first time in our show, Dean Jenkins, Norman Hallett, Simon Jousef, and Dr. Barry Burns.
Welcome, traders. Good morning if you're in the West Coast time zone, or a good day wherever you're calling in from. As Anna said, make sure you ask questions as we go. Make this interactive. I really want to, I'm going to provide some material here that I think you're going to find interesting, but definitely ask questions. And my presentation is pretty short, a handful of slides, and I want to spend a good deal of time looking at real charts and applying these concepts that I'm going to show you. So, have in mind some symbols, some charts that you'd like to look at, and I'll offer my analysis with these tools on those charts once I go through this material. And I am calling in from Olympia, Washington, about an hour south of Seattle. And man, this is the time of year that we look forward to. It is a beautiful day in a beautiful part of the country, and I hope you're having a good day as well. Go ahead and make sure you can find that question box, and just type in that you can see my screen okay, maybe where you're calling in from, as I get started here. But I'll get rolling, and as I do, again, I'm going to look at some real charts. So just a quick disclaimer, I'm a trader. I'm not a financial advisor. I'm not giving financial advice. I'm going to share my opinion, my analysis on some charts. But all trading and investing involves risk, and risk control should always be used at all times. I'm sure you guys are all traders. You can agree with that. Before I jump into the material, let's look at the current market. It's just crazy times, isn't it? This is the S&P 500. I'm showing the E-mini. Pretty choppy today. First down day we've had in several. And the Dow's down about 64, 62 points right now. I look at these intraday futures charts to just give me insight what's going on. I don't day trade. I do my trading on daily charts, primarily stocks and ETFs. But again, interesting time. And speaking of daily charts, I'll show you where we're at on the S&P 500. I'm watching this really, really closely. So you can see the S&P 500, this purple line shows a high that we hit back in June, and we came up to it then this week and reversed so far right off of it. And if this reversal continues, I'm going to be watching my indicators and my setups very, very closely for potentially another down move. And I'll show you how I use these indicators. We'll jump into that now. So the title of the presentation is, like I said, East meets West, how I combine Ichimoku Cloud Elliott Wave, very simple version of Elliott Wave to get some high probability directional setups. Okay, here's what I'm going to cover in my presentation, the tools that I use. I'm going to talk a little bit about Dow theory, a little bit of the background overview of Ichimoku Cloud, which is an important tool that I use, a brief overview of a simple version of Elliott Wave, and then how I bring them together for high probability trade setups. I'll share a couple of my current favorite setups, and then I'll be happy to analyze any charts that you are watching, some trades maybe you're interested in. Who knows, maybe we'll find some good ideas. I often get them in sessions just like this. So I use 3 key tools, like I mentioned, Dow theory, one portion of Dow theory. I use Ichimoku Cloud, and I use a simple version of Elliott Wave. So let's take a look at that. So Dow theory. So Charles Dow, interesting guy, back at the in the late 1800s, early 1900s, he founded the Wall Street Journal, the Dow Jones company, and he wrote a series of articles in his new newspaper, the Wall Street Journal, and those articles talked about how markets move, and they've been collected into books now called Dow theory. One portion of that is trend analysis, and Charles Dow made the observation back then, over 100 years ago, which is still valid today. And he really came up with a definition for a trend. And he said, hey, a bullish trend, an uptrend, is identified by a series of higher highs, higher lows. That's what these, higher high, higher low. As long as this pattern continues, the uptrend, the bullish trend, is still intact. This is super helpful because when you're in a trade, say you take a long trade and it heads up, that's great, you're happy, you're in profit. But when it starts pulling back, you go, well, should I get out? Should I stay in? What am I going to do? And having a set of rules about, hey, when is the trend over is really helpful, right? And as long, pullbacks, price doesn't go straight up. It kind of takes a stair step or a sawtooth up like this, higher highs, higher lows. And so getting higher lows and little pullbacks in an uptrend is totally normal. And it can help you to manage your trade. And it also can provide places to put stops. And that's what I do. I use price action based stops rather than, what I would consider arbitrary percent based, right? So as long as this continues, we got an uptrend, and a downtrend is just the opposite. It's a series of lower lows, lower highs, lower lows, lower highs. As long as that's continuing, we got a downtrend, right? We can confirm using these tools, when does an uptrend begin? And it takes 3 data points. It takes a high, where there, maybe that was going down before or it was channeling before. And then we get a high, a higher low, and a new high. This is the confirmation of a bullish trend beginning when price goes above that prior high. And that can be a good entry point. And I combine that with some other indicators and confirmation that I'm going to show you. But that can be a helpful indication that an uptrend is beginning. And then the uptrend ends when we no longer put in new highs. So if you're in a long trade and this next move does not go on to a new high, it fails, reverses, this is an indication that uptrend is ending. And when it ends, when it takes out this prior higher low, that is a clear indication that uptrend, at least for the time being, has ended and perhaps a correction or retracement is beginning. Bear trend, same thing, just in reverse. A bearish trend begins when we get a low, lower high, new low. 3 data points. This is where the confirmation that a downtrend is ending. Then we put in lower lows, lower highs, lower lows, lower highs. And then that trend ends when it no longer puts in new lows and goes in and takes out those prior lower highs. When you see it laid out like this, it's incredibly simple. This is something that's easy to learn. But when you don't have these definitions, it can be kind of hard to figure out, are we still in the trend? Has it ended? When did it begin? Those kind of things. So I find it to be very, very helpful. So that's a tool I use when I analyze charts. And you can do this with no indicators. You can just look at price action on a chart. And if we just look at the S&P 500 right now, right? I showed this chart earlier. We had, a series of this move up, higher highs, higher lows, higher highs, higher highs, higher lows. What if it reverses here and then starts taking these out, low, lower high, low, lower high? That could be a trend reversal. So I'm watching for that. All right, I use Ichimoku Cloud as well. Ichimoku Cloud, it's also known by Ichimoku Kinko Hyo, which means one look, equilibrium chart. It was developed by this handsome gentleman, Goichi Hisada, who was a Japanese journalist. It was developed back in the 1930s, and he worked on this thing for decades until he finally published it in a book in 1969. Interesting that he began working on this in the 30s, because the other system that I use, the other analysis technique that I use is Elliott wave, and Ralph Nelson Elliott was developing his theory in the 30s as well. So Ichimoku Cloud, how does it work? What's it going on? Well, first, how many of you, and use the question box, how many of you believe that moving averages absolutely matter when you're analyzing charts? Just type in a yes, I don't know, no, whatever your answer would be. Yes, says trader. Good. Most people would agree that they think that moving averages absolutely matters. And Trader says, because other believe them, the 50 and the 200. Well, it's funny you mentioned the 50 and 200, because although I said my primary tools are Elliott wave and Ichimoku Cloud, I've got the 50, this lighter line, and the 200 simple moving average on my chart. Why? Because everybody's watching them, right? If everybody's watching them, I want to know what they're watching and what they're saying, right? And there's an important thing when the 50 crosses the 200, it's called death cross, and when it crosses up, it's called the golden cross, and a lot of people key off that. So I'm definitely paying attention to those. Dale says makes a living on them. Another Don't know, that's all right, but most people say yes, that they believe moving averages matter, and I agree. Okay, Ichimoku Cloud at its core, it's really just a different look at moving averages because it uses moving averages. Okay, a simple moving average like the ones I just showed, the 50 and the 200, are the average closing price over some variable number, X number of previous bars. So some people use, 2 or 3 simple moving averages, look for crossovers and direction, right? And the formula is closing price over X number of bars ago, take the average of that closing price, and they plot a dot, and then the next bar is formed, and they plot another dot, and those dots form a line, and that's your simple moving average line. Okay, Ichimoku Cloud, rather than looking at the closing price, it takes the average of the highest high and the lowest low over some variable number of previous bars back, and Ichimoku Cloud uses 3 look back periods and then some derivatives from those look back periods and ultimately creates cloud. So it is a moving average. It's calculated differently. And let's walk through a couple of the key elements of Ichimoku Cloud. So I got it bolded in yellow here. This line is called the Tenkan line, or the fast moving average line. It's the shortest period. Okay. And so you have a setting in your Ichimoku Cloud indicator control. The default setting is 9 periods. I use a different one, but it takes the highest high and the lowest low, and in this case, the factory setting over 9 periods, and then takes the average, divides by 2, plots a line, right? So it's very similar to a fast moving average line, but again, it is being calculated based on the highest high, highest low, and I think that matters rather than calculating on the close, because the highest high and the lowest low are actually where price were. It's a range that price moved within. So I think it's important to include that in the analysis. Okay. The Kaijun line is a slower line. I've got it bolded in purple here. It's calculated the same way, highest high, lowest low, the average for some look back period. The factory setting on that, I believe, is 22. That'll come up default in your indicator or your study when you put it on a chart on your platform. Okay, so it's similar to a slower moving average line. It shows a little bit longer trend. It can indicate a trend change, right? And you can see a lot of people key off of crossovers, right? So the yellow line, when it crosses over the slow line, that can indicate at least a short-term trend change. So those are 2 elements. There's a third element, which is span A. Senku span A means going first or preceding, and it ultimately makes the leading edge or the top of this cloud area, which is kind of the key of the Ichimoku Cloud, right? So it takes the fast line, the Tenkan line, plus the baseline, which is typically about the factory setting, I think, is 55 periods. Okay, and the average, highest high, highest low, right? And so that's the leading edge, the span A, and then the span B is the slower one, and it forms the lower edge of the Ichimoku Cloud. Okay, and that takes the highest high, highest low average over that longer time period. I think the factor setting again is 55 periods. Okay, again, I use different settings, and I'll show you how you can access those settings. Okay? But those are the key elements of Ichimoku Cloud. The span A, span B make this shaded region, which is called the Kumo, or the cloud. And what's really interesting about this cloud is that it does a good job of indicating, what's the current trend. And in addition to the trend, it gives you a good indication of the strength of the trend, because the thickness of the cloud, the difference between span A and span B, can indicate how strong the trend is. And you can see that it plots pretty accurately support or resistance areas in a trend. You can see, again, Dow theory, uptrend does not go in a straight line. It's a series of higher highs, higher lows, higher highs, higher lows. And you can see how those higher lows pull back quite often right to the cloud, indicating important support areas in that ongoing uptrend. So pretty helpful indicator, my opinion. And you can see then when price breaks through the cloud, that's a really important thing, indicating potentially a trend change. You can see the cloud, when it's going down, it's red, and then it shifts to green when it's going up. Okay, so price breaking through the cloud is a really important indication of potentially a trend change. And you can see price quite often breaks through the cloud when the cloud is thinner, and the cloud, when it's thicker, when we have a stronger trend going on, it's harder for price to break through. So again, I think that's pretty helpful in our analysis, right? This is what it looks like on TradeStation for me. You can see I've turned off the Tenkan and Kaijun because I just want a really clean display. A lot of people use the Tenkan and Kaijun for crossovers. What they want to see is, you know, Tenkan crossover Kaijun and then price to get above the cloud. Well, it's axiomatic. If price breaks above the cloud, I guarantee you there will have been a crossover. It is there every single time. So if that's axiomatic, I don't even need to look at it. I just turn my settings so that they go away, so they're 100% transparent, because I want a clean display. They're being used in the calculation. They are important values, but I don't need to see them, right? They're kind of behind the scenes. So that's kind of what it looks like, and you'll see some live charts here in a minute. Okay. So I'll pause before we shift over to Elliott wave theory, because this is another one of the tools that I'm using that I talked about up front. Use Dow theory, Ichimoku cloud, Elliott wave. Okay. Ralph Nelson Elliott developed Elliott wave theory back in the 30s, and I know a lot of people, when I talk about Elliott wave, they kind of roll their eyes, and you know, because they've seen presentations or, you know, read, you know, gone to websites and read about it. They go, oh man, that is super complex and it's not repeatable and it's subjective and it's this and it's that. And, you know, for many of the applications of Elliott wave, I would agree with all those statements. I use it in a very simple way, right? And I think I stick with what Ralph Nelson Elliott, you know, his original, you know, thesis on this was that, hey, there seems to be a movement, a wave of investor psychology, right? Of sentiment, pessimism and optimism. And it seems to move in kind of natural sequences, right? Kind of like a tide shifting, right? And he came up with some tools to measure that, and then to begin to predict if, you know, if a move is happening, how far would it go, what would happen next. And it turns out those, you know, you can use some tools to do a pretty reasonable estimation of what's going to happen next. You just got to keep it simple, right? And you know, here's the idealized pattern of a 5-wave, you know, up 1, 2, 3. 3 is the biggest impulsive wave, 4 is a corrective wave, 5 is a continuation of the original trend, and after that's all done, there's a complex correction quite often. Okay, I'm really only interested in trading wave 3, 4, or 5. 5 is the best wave to trade, because if a chart conforms to these prior patterns, then the probability of it continuing starts to get pretty high, right? One of the things I think that frustrates people the most when they try to use Elliott wave is they pull up a chart and they've got some Elliott wave rules and shapes they're looking for, and they try to force the pattern onto a chart. And the truth is, not every chart is going to exhibit an Elliott wave pattern. And so Elliott wave works really good. You know, the pattern's going to be there on, say, 70% of the charts. On the other 30%, it's just not there. And you can't impose a pattern on something that it's not there, right? And if you try, you're going to get kind of frustrated. And in my trading room this morning, we were looking at a couple of charts, and I think, let me pull up an example here. We were looking at of, I think it was CAT, right? Here's CAT on a daily chart, Caterpillar, right? Well, try and do an Elliott wave count on CAT. And if you just look at, you know, kind of the shape of price action, you can see it doesn't look anything like this. It's actually kind of chaotic. So trying to impose an Elliott wave analysis onto CAT would be kind of frustrating, right? And it works for bearish markets. You can just flip this thing upside down, mirror it, and it's going to work just fine for a bearish trade as well, right? I trade both bullish and bearish markets. Elliott wave is easy, right? All you got to do is memorize these 144 pattern permutations of grand cycles and super cycles and, you know, and super millenniums. If I were to try and do this, I'd go nuts. I wouldn't use it. So I just put this up as kind of a tongue-in-cheek contrast, because this is not what I do. Elliott wave actually is easy. when you're only looking for 3 trade setups. And here's the best book on the topic. It's written by Bennett McDowell. It's called Elliott Wave Techniques Simplified. You can find it on Amazon. It's a good book to have on every trader's bookshelf in your library. And it talks about how to make a very simple and repeatable approach to Elliott Wave. And I was honored that Bennett invited me to write a chapter in this book, and I did. And you know, I don't get any commission or anything like that. It's just a really, really good resource if you're interested in learning more about a simple, effective way to use Elliott Wave in your trading. So how's it work? Right. So this chart actually does have a nice Elliott Wave presentation. This is a chart from a couple years ago on Vail, a mining company. This was a live trade that we actually took, right? So you can see here's a move, right? Wave 1, 2, big move up 3, a correction 4, and now heading up into a wave 5 target zone. And here's the trade setup, right? Here's the entry as wave 3 gets confirmed, and here's how I'm using Elliott Wave and Ichimoku Cloud, because you can see price, as I took my entry, price was just breaking above the cloud. That was a confirmation of a trend occurring. And we had the correction, and then here was my entry on wave 5, right? So here's Elliott Wave, or sorry, here's Dow Theory, right? Wave 1, right? We got a high, higher low, and right as we get our new higher high, price breaks the cloud. It takes out that prior high and it breaks the cloud. That's a powerful setup for me. I'm going long right there. Yeah. And then trade plays out, right? Goes up to wave 3, we manage it, we get a win. Correction begins. And in wave 4, there really wasn't reward to risk. And as we analyze some live trades, I'll explain my reward to risk analysis and criteria for a trade. Because, you know, having a trade that has a probability of going in a direction is, you know, certainly one of my criteria for taking a trade. But the reward on the trade's got to be greater than the risk. There has to be good potential reward on a trade. So that correction, there really wasn't, right? Because we can predict using Fibonacci retracement. Once this wave has happened, we can predict how far it's going to retrace. 75% of these are going to retrace into a Fibonacci zone between 38.2 and 61.8. And boom, it did perfectly. And we can predict this retracement zone way up here when this thing starts to end. Okay. And then after the retracement, we look for evidence of the next setup, right? We want to see a high, higher, low, new high, right? And then we can predict where wave 5 is going to go with Fibonacci extensions. Pretty cool, right? So here was a high and a higher low, but then it failed. It did not make a new high. So that was not an entry, right? And also look, didn't break the cloud. How interesting is that? So here we had another high, higher low, new high. Took out this prior high, made a high, broke the cloud. That is a good, powerful entry setup for me. So we took that entry. Bam, got another win. So 2 wins, right, on the same chart on wave 3 and on wave 5. We can trade wave 4 if there's sufficient profit on it. Okay, and then once I'm in the trade, I use Dow Theory for my stop management. As we put in higher highs, higher lows, higher highs, higher low, I trail my stop to the new higher lows. Every time a new higher high is put in, I just trail my stop. Ultimately, you know, take profit in, you know, probably thirds usually going up, and then finally get stopped out on the last move. Right, so I just use Dow Theory for my stop management in the trade. That's really the crux of my, you know, the key tools that I use. I use Dow Theory, I use Ichimoku Cloud, and Elliott Wave. Okay. Let me now apply that, right, to live charts. I'll show you a trade setup that I like right now. And then while I'm doing this, if you got some symbols you would like me to analyze, I'd be happy to do it. Okay, and there's trader, got Tesla. I trade stocks and ETFs. I trade primarily on daily charts. So if you're doing something different than that, if you want a shorter time frame, be sure and indicate that, okay? And Solanke wants a couple Forex pairs. I can pull those up. All right. So let me show you first the trade setup that I like right now. And it is not CAT. That was my example. Bank of America. They just announced earnings this morning, so it's a little bit early. But let's take a look at this chart. What is it I like about this chart? Okay, look here, right? And you see I got this price oscillator. This helps me. So this, I got the Ichimoku cloud, I got some moving averages, and I got a price oscillator here, right? This oscillator helps me identify wave 3, right? So, and you can see it in price action. Wave 3 is always the biggest, highest momentum move on a chart. So here we had wave 1, 2, low, lower high, new low, right? There was a great short on Bank of America here, right? And we did really, really well back in February and March, taking some trades, some short trades. Saw this coming, used the tools, made some real nice profit. All right, so that was wave 3, that's over, and then it drifted up in a correction into wave 4, right? And my Fibonacci retracement zones are these blue lines, right? And the perfect retracement stays between them. This one a little higher, but as long as it stays below this red line, 76.4, it is still a valid wave 4, right? And you could see Dow theory told us that trend was changing with a series of high, higher, low, high, higher, low, right? And then what do we got now? Low, lower high, low, lower high. Now it's heading down. They just reported earnings, it's down 2%. And look, we are below the 50-day moving average, and we are below the Ichimoku cloud, and the Ichimoku cloud has shifted from up green in the retracement down to red. Now continuing that original trend from wave 3, downtrend. Okay, so using Dow theory to analyze this trade, I would put a stop. This is the point that I would exit this trade if I take it right here above this high. Because if price goes above this, what's Dow theory going to tell me? We had a high, higher low, new high, not in a downtrend. So that is the point that I would exit. I'll go ahead and make that line red so we can see that that would be my stop. That would be my exit point. Okay. Let's say I took an entry right now, and I'll just go ahead and mark my entry in azure, light blue. Now I like to mark my charts up so I can see just real clearly when I come back to this chart later what my setup is. Here's the wave 5 target zone. It's these green lines between a 61.8 to 100% Fibonacci retracement. Now I like to be conservative in my reward to risk analysis. And I say, okay, pretty close to the edge of that target zone is a pretty major pivot point, a pretty major prior low. So what if it failed right there, right? Would this still be a good trade? So I'm going to mark this as my target, right? Let's make that green for profit, because if it hits that line, I'm in good shape. I've made profit, right? So if I want to short this, my entry would be here. My stop would be, just one tick, right about there. And here's my target. So I can visually look at this trade and estimate the reward to risk on it. Because if I take the trade, it fails and it hits this stop and I close it, this is how much I'm going to lose per share. And that is what? Less than 30 cents, right? 24.93 is the stop, 24.07 is the entry. Going to lose, what, 80 something cents per share on a $24 stock. That's acceptable. If I win, if this trade goes to my target, right, I'm going to make, 18 from 24, that's 6. I'm going to make, $6 on a $24 stock. That's like a what, 25% more? It's big, right? So the reward as a ratio of the risk is huge, right? This thing's got a 5 or 6 to 1 reward to risk ratio. That's what I like. That's the kind of trade that I want to take. And I typically would take this with options, and I would go buy put option and give myself, a good 60 days, go buy deep in the money. So I'm not paying for time. I'm not paying for IV, right? I don't have to worry about time decay. Go get the August, at this point, go get the September puts, buy one in the money with a good delta, 70 delta or better. And that way, if it goes this way, my option contract is going to double or triple in price. I'm going to get a home run out of it. And if it goes up, hit stop, I lose a little bit, get out of the trade, move on to the next one. So that is how I approach my trade setup, my analysis, and then my trade execution. And then once I'm in it, as it puts in lower lows, lower highs, lower lows, lower highs, I'm just going to trail my stop down. I'm going to take profit, probably as it crosses a Fibonacci line, as it crosses pivots, take a third off, and then let that final third run until it hits the last stop, and then I'll close the trade when the trend is over. This is my target. I will not get out just because it hits the target. Target's there, so I'll make sure I have sufficient profit potential. Right? But if it wants to run deeper, I'll run with it. Let it run. You know, keep the winners big. Let your winners run. You know, cut your losses early. Everybody's heard that before, right? In trading. So there's the setup. Bank of America short. They're just past earnings. It's a go. I'm probably gonna take this trade. All right. So now we got a couple of the traders online have put in a couple of suggestions, so I'll analyze those for you. Okay? First one up is Tesla. Everybody's looking at Tesla, right? The most shorted stock on the planet. I think I read that 20 billion are bet against Tesla. So obviously it's been in a run up. This is wave 3. It has started pulling back. And according to my rules and my analysis, this correction has not been confirmed yet. All we have is a low, right? So I would not short this yet. I want to see, this is a good start, a low, and then a lower high that does not go above here, and then another low, right? So 3 data points, low, lower high, new low, and I want to see a crossover on the Ichimoku cloud. If we get that, then we could have a short setup. I would not take this long at this point. It's just kind of mature, right? And it looks like it's running out of steam. If we get that low, lower high, new low, then here's the Fibonacci retracement zone, the target, and it's between these two blue lines. And the question will be, after the setup comes, what's the reward to risk? Where would my stop be? Where would my target be? And is there a good enough reward to risk on the trade? So I don't know. Those are unknowns until we get the setup. But that's what I'm looking at on Tesla. And then Nikola, NKLA, competitor, right? I don't know, have they built a car yet? So very similar, you know, huge run up. They did already have their correction, and look, so there's the setup low, lower high, new low. The correction happened right into the Fibonacci retracement zone. So what's next? Now we're looking for high, higher low, new high. So the entry on a long would be here, and the target is up here, and that could be good. So that's just got to set up, and it's getting close. So that's interesting. Work. And one question's asking, does it work intraday? Yeah, the analysis technique, all it needs is price bars. When I analyze a stock chart, I like to start with about 18 months worth of data. Right? I want 150 or better price bars. And you can do that with a 2-minute chart. You can do that with a tick chart. You just need good history to get a big picture. You can do it intraday. You can do it on weekly charts. The setup works. Because it's based on patterns, based on having a good number of price bars. All right, work. Fairly new issue here. You can see there's not a ton of history, and you can see kind of this big U shape here, right? When you take out the anomalies. Right? I said not every chart would conform to Elliott wave, and this one really doesn't. And so he had a big impulsive move clear down to here, but then this retracement was too big to be an Elliott wave retracement. You see how it went above this red line here? So this became the new impulsive move. It's in a correction, right? And you can kind of walk the waves forward, right? So you could call this wave 3, and then it retraced, currently in a wave 4. So it's in a kind of a choppy channel. If you were to start taking out like this high here, right, then, it did retrace into this zone, so you could make a case for a wave 5 if it puts in a new high, gets above it, and then you would say, what's the reward potential up here above, 44.81? So maybe. So you can as you walk through the price moves, you can start to construct an Elliott wave scenario there. Not the best, but maybe there. So long he wants, let me look at the Euro JPY. Let me make sure I can type this right. I don't trade Forex, but again, you can apply this concept to any chart. So here's the daily. I'm not sure what time frame you're interested in. And when I analyze a trend, I always want to go back and see where did it begin, right? So the downtrend began clear back here. So I gotta, oops. Oh, the farther we look, and when I see this, when it's like, man, this thing is off my chart, I'm gonna pop to a bigger time frame for a minute, just see the big picture. So there's a weekly. And what we see here on the weekly was a move up, a retracement down. I think it stayed in bounds. Yep. And then a failed move there. So the current move is here. This is a tough one. It doesn't really conform very well, but it's worth taking a look. So what can I say? It was in a big downtrend. It corrected up. It looks like that correction may have a little more bit of a leg. These corrections often move in an A, B, C. So maybe up to this high, maybe above it, but not super good. Let's look at USD JPY just for fun. And you can see this is erratic, right? It's got big swings and retracements. There's no orderly pattern for me, and so I avoid a chart like this. I look for very orderly patterns personally. Dale brings up USO. USO is interesting. If you've been following that, when oil crashed and the futures went negative, it really kind of broke USO's model. I think they may get their act together, and their futures broker bailed on them. I think they're gonna figure that out. But it's creeping up, right? It is not keeping pace. This ETF was designed to track the price of oil, and because of the big breakdown in futures contracts, right, they are no longer tracking the price of oil, because if you look at here, oil futures, right, had this huge run up, and USO is supposed to track that, but they didn't. So they're going to get it back together, maybe. I think you need to understand that backdrop before you try to trade this, because it's not doing what it's designed to do. You can see it did break the cloud. It is starting a correction up. If it can do it, the midpoint of that's about 62. But there's some mechanics in the background that you want to be aware of. Okay. And one of the questions was, can you analyze? Well, I showed an ETF. XT. I don't know that one off the top of my head. I want to watch the time real close here. I'll do this one, and then unfortunately it's the last one because I don't want to step on the next speaker. Exponential Tech. I share Exponential Tech ETF. Interesting. Volume's a little low for me. Here we are, a couple hours into the session. They've only traded 35,000 shares. I like hundreds of thousands of shares. I like deep liquidity. Because this was so low, right? This is the current impulsive wave. So you'll be looking, you can see the momentum's coming out of it. So you would look for a correction, low, lower, high, new low, and the target would be down in the midpoint down here. So I would not try to take this long. It looks like it has run out of steam. I would wait for a setup and potentially take it short. Okay. Yeah, I got just a couple minutes left, and I wanted to leave you with some information if you are interested. And sorry I couldn't get to all of them. There just isn't time. Appreciate your interest. All right. So here's a special offer if you'd like to find out more, right? I do offer a stock and options picks service, right? I publish trades to subscribers. The trades that I'm taking in my own account with my own money. If you want to find out more about me and my business, here's my webpage. It's followmetrades.com. I believe in complete transparency. Here's my results over the last several years. We're having a great year, and you can go down here to any given year, this year, last year, whatever. Click, and you'll get the details of every single trade. And my results are audited by a third-party CPA. So if you'd like to learn more, followmetrades.com. If you'd like to follow along, I do have a special offer. Again, $37 to take a 30-day trial, and you can follow along with the trades that I'm taking in my own account with my own money. And there is that link in the chat box. And then what do you get? You know, with this service, you get a watch list of potential trades, like I just showed you BAC, alerts, text and email when I'm getting into a new trade. And I just launched a new app, so you can get an in-app notification if you want. You get the exact details of every single trade, entry, stop, target. Most of them can be traded either with shares or with contracts, and I provide an option contract that I'm going to trade it with. You get alerts when I make a change, move, stop, take profit, close trade. You get access to my live trading room Monday through Thursday, 30 minutes at the market open. You can attend if you like, it's not required. We do record it, there's a recap. I have a live chat session Wednesday evenings. You get a one-on-one consultation. You can get time on my calendar. We can get you off to a good start, answer questions. I provide tools on risk management and option trading, some tools there, some training, ongoing support, and there's more. If you're interested in my approach to Ichimoku Cloud, Elliott Wave, I have a course. The list price on that course, $247. If you take this trial today, $37 for 30 days, I will give you this course for free. It gives you my proprietary cloud settings, written study guide, training videos, printable trade setup cheat sheet. Okay, that's only available during this session. So with that link that I put into the chat box, if you sign up, you're going to get 30 days of my picks, the trades that I'm going to trade, 2 to 3 trades per week. You get access to my trading room where we're going to do exactly what I just did here. We're going to analyze trade ideas, be looking for the next great trade, answer questions, and you'll get my Ichimoku Cloud Elliott Wave course. And even if you take the trial and it's not my thing, you get to keep the course. So that is it. I got 2 minutes left. Are there any other questions anybody's got before I hand it off to your next presenter? I don't see anything coming in. Well, hey traders, thank you for your attention. I hope you found this useful. And again, I'd welcome you to take a trial, come check it out, be in the trading room, and join in on some winning trades.
Thank you, everybody, for being here today. I know that the majority of people in the trading arena, and I mean anybody who's ever touched a mouse to a position, is very interested in in where to buy and where to sell, and that's very, very important. However, I think if you and the equal importance is the discipline to follow the trading plan. I was just looking at you probably have seen advertisements for a big. We have four or five speakers here. What I like about Anna is when she puts together some really high-end people. I guess I'm complimenting. It's a way to self-compliment. It's like when I play tennis. I'm a pretty good server, and when somebody returns my serve and they make the point on my return, I always say, hey, great return, which is kind of a way of saying great serve to myself. So I got to be careful about that. But I just saw this conglomerate of 40 speakers, and of the 40 speakers, there was not one of the 40 speakers that focused and had a presentation on the mental and emotional issues, even though they will all admit, every presenter of the 40 would admit to you, gun to the head, is that it is of at least of equal importance to a trader's success, the mental and emotional, getting out of your own way. And so I'm here to say that if you're one of the 90% of traders who are struggling, then it's probably because you may be one of the 90% of traders who pay little or no attention to the discipline of trading. And I want to help you fix that right here with this presentation. At the end, I'm going to give you something that's kind of irresistible for you to give a try and see if you like the feeling of actually being in control when you trade. And our our process, our assets can do that for you pretty quickly, and you're going to get a chance to do that free. So let me go through what I consider the 5 master keys to disciplined trading. And I think, and I know that these 5 master keys have come from the people that we've coached through the years, and I've been doing this since 2000. The particular corporation was formed to focus on helping traders with their mental and emotional issues. Now, I've worked for Payne Weber. I ran one of the largest option firms in the country. I've been a CTA. I've had an IB. I have done it all in the industry except for being a floor trader. And I wanted to. I didn't want to do that. I mean, that's a little bit too stressful, even for me. So, but I do have the experience of helping traders get to where they want to go, especially through the mental and emotional constructs of what I'm about to show you. So let's get into the presentation and see what I'm talking about. Is that okay with everybody? And you can just say attaboy Norman in the chat. Okay, let's get going. Why do traders resist training for their trading discipline? Why do they walk away from me? Well, only the people that aren't in my program. Why are they walking away from me at the expos? And the reason is because when you meet me, I'm going to ask you a question about yourself. I'm going to be asking you to look at yourself and analyze. This is why journaling, incidentally, is so important. But you need to take responsibility for the mistakes that you made as a trader and then make the move to correct them. And most traders don't do that because they believe really all they need is the right guru to point them in the right direction of when to buy and when to sell. And of course, when they hand you trades on a silver platter, boy, that's even better. Just, I don't even have to think about it. Just give me the trade and I'll be good. Well, you won't be good. I'm going to tell you right now, you're not going to be good. Well, unless you're one of the, you're not likely to be good with it because you'll be one of those 90%. But if you want to break into the 10%, it's really all about self-inspection and self-improvement. And I'm only talking about 7, 8, 9, 10 minutes a day to do that. You're trading an hour, 2 hours, 5 hours, the whole day. If you're a full-time trader, take 10 minutes to get your head together. You got to look at yourself. You got to take responsibility. This is why, this is the resistance. People don't like to do that. They would rather blame the market than blame themselves. They're too lazy to put in the work, even if it's 10 minutes, because in that 10 minutes they have to say, hey, I've been responsible. I have to take responsibility for my blown out trades. It's not them, it's me. I could have chosen not to take that trade, but I didn't. I was too excited to take it, not to take it, so I took it. And you've got to measure. You got to make measure of yourself. And traders, they seem to be too lazy to do it, and that's why they keep blowing out accounts. Finding the Holy Grail, just mention that. That's the most important thing. No, it isn't. It's really the second most important thing. And the reason is because there are plenty of Holy Grails out there. There are plenty. We have our simple trading plans that work very well for traders, but a Holy Grail, they're out there. There's a lot of different ways to make money in the market. I mean, Dean just showed you some simple ways to look at markets and take advantage of it. I mean, listen, there are plenty of ways to approach the market. It's the approaching yourself that you're probably missing. Okay, so Master Key 1, a sound trading plan structure. I've written several books on this. One of them I think is still available on, yes, it is on Amazon. You'll see maybe several books there, but one on constructing a trading plan and designing a trading plan. A trading plan has to reflect your own philosophy. Now, Dean talked a lot about, in the presentation before me, Dean Jenkins talked a lot about Fibonacci. And, I think anybody with any kind of math degree really likes Fibonacci. I happen to have a math degree. If it was any less of a degree, it wouldn't be a degree. It's a bachelor's in mathematics because I couldn't get through engineering. Well, I probably could have, but it was a real struggle. I had trouble with mechanics. Believe it or not, a guy who writes books on trading plans had trouble with mechanics at the University of Cincinnati, one of the best engineering colleges. So I added up all my credits. I left with a degree in mathematics. I mean, when they got to imaginary numbers, I said, what is this? Imaginary number theory? Let's deal with the real world. So you need to find out what you believe in. Fibonacci is, for instance, is a it's a universal law. It's the way universe. It's the way galaxies and are formed. The spiral galaxy is an example of a Fibonacci expansion. So is the arc shell. So are the waves of the oceans when they come in. And so why not the market? I mean, we're 90% water. We're water bags, really, and so why wouldn't we? Kind of makes sense. There could be a connection. If it controls everything else, why wouldn't Fibonacci? So I tend to believe in it because I have a math background and I believe in it. If you don't believe in what Fibonacci is about, do not use it, please. Please do not use it. Because you'll doubt it and you won't follow your trading plan, and then you'll be blowing out your account and you'll be opening up another, or you'll be slowly dripping in your account, which is even worse. I'd rather see you blow it out quickly and get started, make a new commitment, draw a line in the sand, and work on your mental and emotional. But find out what is true for you. I love candlesticks. I love Fibonacci. The Japanese thing makes all the sense in the world to me. The open and the close being the most important part. That's what the candles are about. So love candles too. What is it for you? And then when you go looking for a holy grail, at least you have some artillery to go in there. I mean, if you don't know the price of a car, the average that everybody, if you haven't tried TrueCar, if you haven't checked out the price of a car, what everybody's paying for it on average before you go into the dealership, you're crazy. You know, you got to have some. And so before you look for a trading plan, decide on what fits you and what's right for you. And if you don't even know what Fibonacci means or candlestick means, there's a million things online. Look at it, find out about it, then go ahead and grill your guru and find the right match for you. Okay, trading psychology. You got to have a section for it in your trading plan. We're talking about your trading plan structure right now. You gotta have a section. You have to write it down because you have to make it part of who you are as a trader. Okay, your trading psychology, it should be in your trading system. You need to know a time frame. Are you a long-term trader, a swing trader, an intraday trader? These are decisions that you have to make, and you can't look at somebody's system and say, well, that looks good for me. I think I'll be a long-term trader, because life could get in the way. Figure out there's plenty of great systems in each one of these categories. What kind of time frame do you have to trade? Remember, don't get crazy about trading. It can take over. It can be, it can control your life if you don't watch it. It's addicting. So make sure that you decide on the time frame that you want to be trading in, and then match the portfolio or your trading plan to whatever you want to match to yourself. Risk evaluation and control, probably the most important part of a trading plan. And it can be different for each time frame. Okay, I won't get into that right now, but risk evaluation and control, very important. Analysis. Are you a technician or fundamental analyst? If you're a fundamentalist and you try to be a technician, when you hear something on the news and the technicals tell you to go, you're going to doubt it if the fundamentals are in a different way. The technicals may be telling you that the market is already turned around, as far as they've already considered all the negative information that is and what could be in the next 3-4 weeks. It used to be 6 months. It's a shorter time frame now. So when you listen to something fundamental and you look at something that fundamental, it's already kind of old news to the technician who's included it in the price. A fundamentalist has got to give themselves a little bit more room for being wrong in the beginning before it works out if you're a fundamental trader. But decide the kind of trader that you are, okay? And the entry and exit strategy. I capitalize exit in this because the most important part of your exit strategy is the most important part of your strategy is not your entrance strategy, it's your exit strategy, okay? So remember that when you're constructing your trading plan. It's easy to get in, but how do you get out? I call them nuances. In our simple trading plans, what I do is I come out with a one-page trading plan, and then after that, I add nuances. Those nuances are things that you can take as an optional list of things to improve. I've noticed that they all improve your results, but whatever fits for you, add that to your trading plan. So this is the way you should do it. You should build a trading plan, have it set that trading plan, work with that trading plan, give yourself a track record of 3 months, 6 months, whatever it takes for you to feel no less than 3 months, for you to feel solid about that trading plan. And then as you're working with that trading plan, notice what may have been improved it along the way, but do not make the change. And then at the end of a few months, start introducing some of those things that you notice make it a little bit better trading plan, okay? Nuances, and I think that's the best way. I know you've never heard that before, but I'm telling you from a guy who's built a lot of trading plans, try it out, and that's for another discussion. Okay, again, the master key, number one, is the sound trading plans. Here are the elements of a trading plan. Define your entry signal. Define the stop level and position sizing. Those two areas are the areas I'm going to get into in a second. Determine your exit signal and define your uncle point. Okay, your uncle point is the point at which you give up on a trade. As kids, I don't know if they do. We used to. I guess you're not allowed to pin somebody's arms on the grass with your, anymore. You pin their arms down and they give up and they say uncle. Okay, so uncle is when you give up. This is what we did in the play yard, in the schoolyard, and it's true of you got to have an uncle point and say, okay, clear the slate, because I'm going to tell you right now, when you get out of a losing trade, the clouds dissipate, because your next thought is, what do I do next? Now, you can't rush into a revenge trade or so on, but you get to reset and build back. I can't tell you how many times I've had 2 or 3 losing trades, reset, and then took on another trade that got it all back. Happened to me this morning. I'm in a trade right now, and if you happen to hear an announcement on the computer, it's because I took a profit. Or I got stopped out, one of the two. Okay, master key number 2, proper risk and money management employment. And I'm saying to you that of all the things, all the traders that we've coached, it is the controlling the risk that is the most important single element, okay? There are 3 levels as I see it. The trade level. In other words, you take a trade. I trade a lot of futures. I trade some stocks. Even Forex traders, anybody who you measure your risk level and you put your stop in, okay? And you put your target in if you're that kind of a trader, if you're not following up on the bottom of every candlestick going up, or however you control your risk. But you have a trade level that you construct your risk. Then there's a portfolio level. For futures traders like myself, I like to take small positions in a lot of markets until they expand, and I can add positions. Never add to a losing position, incidentally. Always you can add to a winning position, but never losing position in any event, and carefully to a winning position, and with the proper structure. So anyway, the portfolio level is the level of risk that I'm willing to take on all of my open positions at the moment. So you have a trade risk level. You shouldn't take any more than a 2% risk, and really in these kinds of markets, it should probably be more like a 1.5% risk maximum trading risk on the equity in your account. Portfolio level, I look at in an experienced trader, it's 5% for me. Very seldom do all my trades lose at the same time, but if they do, if they all hit my uncle point, then I know that it's under 10. I know that it's under 5%. So if I have 2 trades that are on that have 2% trade risks on them, I can't put on a third trade that's any more than a 1% risk. I think you get my point. So the portfolio level is an important level to consider if you're trading multiple levels. But the business level, and I consider trading a business, I consider your management of all your entire portfolio as your business level, your IRA, your trading account, your investment account, whatever that is, all of your accounts. You need to construct a risk level trading plan. So in your trading plan, in an overall trading plan, it's another story. But when you think generally, you have a business. All of your accounts need to have a point at which you're not willing to risk anymore. Okay, so you've got 3 areas of level, and here's the other picture I wanted to show you. This is where you should be spending your time when you're constructing a trading plan, when you're analyzing a trade. The entry point is the easiest thing it's what we all seem to concentrate on, because it's really and it's very important. It's the starting blocks. You see, especially in the 100-meter dash, if you don't get out of those blocks properly, if you're a horse race enthusiast, if you don't get out of the gate, and they're off, if you don't get out of the gate, quickly and consistently, you're not going to be successful for the most part. You're going to miss trades. You're going to miss trades. You're going to chase trades. That's why it's important to be strictly conditioned to take a trade when your trading plan gives it to you. You have your entry point set up. It's usually and it usually has a trigger. You take that trigger, you're in. But before you do that, you need to consider your position sizing. I don't like to take a trade unless I can put on at least 2 increments, 2 positions. If you're a trader that trades 100 lots of stock and that's your position that you're going to ride with, I look at that as a 50 share increments. Okay, and the reason I do, same Forex 2 positions, futures 2, 4 positions, whatever it is, I look at it. I look at it as 2 units. And when the market makes its initial move, generally, I think if you look at your trading plan, it's a good trading plan. You usually have a nice jump right in the beginning of your trade. I take a profit on some of those positions, on half if you've got 2 positions, on 50 shares if you've got 100 shares. I take a trade on the first impulse in my direction. And there's ways of measuring that, and we can go through that another time. But suffice it to say that position sizing is important. So many traders put on too many positions. You're much better off downplaying your position size than you are amplifying it. Now, I will say that if you're a futures trader, please do take a look at the micros and the mini and the mini, micro mini in things like the bonds. Well, that's on an ICE exchange, so it may be tough for you to trade the gold, the S&P contract, the E-mini S&P, and crude. That was where I made my money today on the crude market, and I used it in a mini. I had several mini contracts. They're half contracts of crude. Much easier to handle. Much easier to take a quick profit on something and let the other run to your basic trading plan. But part of my trading plan is always taking a profit on the first impulse. So I'm just saying that when you look at position sizing, look at the alternatives that you can have by taking smaller positions, and of course position sizing, as people usually consider them, it's one thing to take positions, but if you have too big a position, that can hurt you. Okay, so the exit position. Exiting your position should be where you spend most of your time, because that's where most people screw up. Okay, the exiting position should be strict and put into your trading plan so that you have something to follow that gives you guidance along the way that you can execute without having to think about it. Because it's the exit part that you start saying, boy, this thing is really taken off. I don't want to. It's giving me a nice profit. The target's a little bit away, but I'd hate to lose that profit. Let's bring that stop up a little bit. This is where traders go wrong. You have a plan. You've back tested your plan. You've forward tested your plan. Run your plan. Don't worry about it. I wouldn't have been able to take that nice profit today if I worried about my position backing off and taking some of my profit. Okay, so exit is where you should be spending the half of your time. Position sizing the next half, and entry, you got to spend time, but you're going to do that anyway. Spend more time on your position sizing and your exit, please. Okay, reversing. And now that was, so I gave you master key 1 was the. I know I'm talking fast, and I'm sorry for you where that English is not your first language, but you'll get the recording of this and you can slow me down, I'm sure. The first master key was creating your trading plan. Second was the money management. The first is reversing your poor mental trading habits. Okay, this is where I really have focused most of my attention when I work with traders. The root of trading habits, good, bad, are the subconscious mind. What the subconscious mind holds true for you dictates how your conscious mind will make decisions. Okay, so train your subconscious mind with thoughts and beliefs supportive to the disciplined trader. And that's you, the disciplined trader. You're either a disciplined trader or you're an undisciplined trader. It's like being pregnant for you women out there. Men don't understand this. You're either pregnant or you're not. I mean, you don't even have to show your belly yet, but you know you're pregnant. There's no stopping it. Okay, I mean, you're either pregnant or there's not a middle ground. You're either a disciplined trader or you're not a disciplined trader. You either give a darn about it or you don't. There's no middle ground. I mean, you can give a darn about it start to work on your trading discipline by working with your subconscious mind. And what I'm about to give you free at the end is going to help you work with your subconscious mind. Okay, so don't worry about that right now, but it's supportive. You've got to support yourself as a disciplined trader between your ears. Okay, the subconscious characteristics of a disciplined trader. Here are the things, and I have a whole presentation on what you're about to see in this slide, and it's going to hurt some of you when you see this, but know that there is an answer to this, and you can change these ailments. Okay, some of you probably suffer from a lack of strength to pull the trigger. You've got to be able to pull the trigger when your trading plan gives it to you. Otherwise, you're going to be chasing trades. You're not going to be the successful trader that you want to be. You can take all the signals from Dean Jenkins as you want. He'll be the first one to tell you. But if you don't have the strength to pull the trigger, you're not going to get anywhere. Okay, you're going to be chasing trades. You're going to be disappointed. You're going to jump on the next B trade instead of an A+ trade. Okay, overcoming the thoughts of fear and greed. And it's the fear. When I ask traders, and normally I poll you and you respond to me, but I don't have the time to do that. I almost don't like presenting this way because I'm kind of attacking you a little bit. I think some of you may feel I'm not attacking you. I'm putting my arms around you and I'm whispering in your ear. I know you have thoughts of fear and greed. Okay, well, maybe I'm not. And we both have masks on, so I guess that's okay if I hug you. Thoughts of fear and greed. You know, if you lose 2 or 3, 4 trades in a row, doesn't mean your trading plan is done. 5 trades in a row, you may want to stop and take a look at why you're losing. 5 is my number, 5 or 6. Then I stop and I stop everything and I look at my trading plan, make sure it's still working, and see that what happened was an anomaly and I can continue with my trading plan. But the fear that you have, some of you after 1, 2, 3 losses, you're doubting your trading plan. That fear is enough to cause you not to pull the trigger, because fear is a layered thing, and we can get into that some other time. But trading to make money, you've got to trade to make money. If you are not thinking about your trading as a business, you're way off base. When you take a loss, that is the cost of doing business. It's like somebody advertising in a business, and they know you got to put it out. You know, it's a losing prop, but you're going to get it back if your advertising is good. When you take a loss in trading, you take a loss. It's part of the overall winning procedure. Winning is a combination of winning and losing. If you have a decent trading plan, you're going to win more than you lose over time. You're going to be fine. So you've got to, and so when you don't look at your trading as a business, what will happen when you make a nice hit, like I did today, $600 in a $10,000 account, you can say to yourself, okay, hey, I got a little room here. Let me take this trade. Looks good. I'm working with profit. I'm working with profit money. No, you're not. You're working with core money. When you P&L a trade, that's now your base. That's your equity. And so when you do your math about how much risk you're willing to take, you do it based on now the new amount after you put that money in the bank. When you P&L trade, you're putting money in the bank. It's not stuff. It's not something that you can be easier with as far as losing it. Okay, so think like you got to think like a business person, like an entrepreneur. Visualize your success as a trader. You've got to use your mind to see the result. And I'm not saying wish for a trade. I'm saying that when you visualize that you're going to have a successful day, that starts the ball rolling with, well, what does that mean? It means that if I just vision that, I know I'm going to have to do a little subconscious training before I'm going to have to put some good stuff in my mind for 5 or 6 minutes, like I'm going to show you how to do at the end of this. And you can do that, and then you're going to know. Then when you visualize success, you're going to say, hey, I'm going to have to take a trade when it gives it to me. I've tested my trading plan. It starts the ball rolling in the right direction. You have to visualize yourself as a successful trader, not only in general on the weekends when you got except for 6 o'clock on Sunday when trading starts for futures people, but you have to continue to have that visualization that you are strong. You've got to have the strength to take your losses. If you don't take your losses, you're going to run into trouble. I don't have to explain that one. Okay, sustaining focus. Listen, trading can be a long day for some people. You got to take breaks. You got to sustain your focus. Exercising patience, probably the one element that nobody talks about with the kind of emphasis that it deserves, but exercising your patience is the most important. What our feedback, I'm not just saying it's the most important feature of a trader, I'm saying from the feedback that I get, when I asked the question, what is the one particular training that we gave you, the mental and emotional training, the 7-minute trainings that we give you, what is the one that's turned it around for you? It's patience. Exercising patience, waiting for the signal to cross, waiting for the market to come off that Fibonacci retracement level and give you a positive signal or a negative signal, depending which way you're going. Exercising patience is, and the great thing about exercising and learning how to exercise your patience as a trader, the other thing we hear from traders is that now they're more patient with their wife, their dog, their kids, their workmates. Patience is a beautiful thing. And if you don't have it, I'm going to show you how to get it in a second. Sustaining discipline. Trading is a marathon, not a sprint. So if you're not doing things to sustain your trading over the long term, and that means building neural pathways in your mind, and stress management, of course, you need to do that. But I'm going to tell you, once you start controlling the way you think in your trading, the way you act in your trading, the stress decreases on its own. Okay, here's the 4th master key. Okay, and it's effective self-analysis and response. We talked about that a little bit when I'm joking, but it's not so much of a joke when people see me and it's especially when they were going to be coached, but then they decided not to, and they're still doing the same thing in their trading. And they won't approach me. They see me at the trading expo speaking or whatever. I'll see them in the audience. Sometimes they'll kind of turn their head when I look at them. You got to journal. You got to journal, because journaling is your way of self-measurement. Okay, it's just you got, and you can make a statistical review of your trades. I don't happen to trade. I look at my trading. I look at my daily sheet from TradeStation. I look at my monthly. That's enough trade review for me in order to make it real for myself to start thinking the right way. Self-evaluation and critique. How did you do it? I'm going to give you a suggestion. Okay, here is what, if you take nothing out of this, how much time do I have? I've got 5 minutes. If you get nothing out of this talk, here's how you can, here's what I do to trade. I journal 4 and 6 minutes a day. Okay, here's the 4th 4-minute part. I do it twice a day, 4 minutes at the end and 2 minutes in the morning before I start. And here's what I do. I ask myself I got my book in front of me, blank pages. What did I do right today? At the end of my trading day, what did I do right? Okay, I took every trade without hesitating. Everything was great. Everything, you know, I say something, I start with a compliment. Okay, I critique myself, but I want to know first what I did right. It's not all about ripping yourself up, because if you rip yourself up, you won't journal. Okay, it doesn't feel good. What feels good is understanding what you did wrong and then correcting it. Okay, what did I do right? I start with something great. Today I took every trade. Where didn't I follow my trading plan? Well, you know, I did have that one trade where I moved my stop and I took a loss longer than I thought. So these are things that I'm writing in my book. Okay, so what did I do right? I start by saying, today I took every trade my trading plan gave me. Okay, where did I follow? Where? And then my next question I answer for myself is, where didn't I follow my trading plan? Well, today I was, now get this, I say today I was unlike myself, or I was un-Norman-like. I'm willing to admit the problem, but I'm not owning the problem, because that's no longer part of me. Okay, so where didn't I follow my trading plan? Today I moved my stops when I shouldn't have and took a larger loss on one of my trades. That was unlike me. Okay. Okay, so that's how I write it, and I have a formal way, more formal. But you can, if you just listen to this and repeat it get this down. It's enough to get started. Okay, what caused me not to trade? Not only is it important to say I moved my stop, but what caused me to do it? And and so I will write that what caused me to do it. I moved my stop today, and I shouldn't have. I listened to a talking head on TV and somehow it influenced me. That's unlike me. Okay, and that was an un-Norman-like thing to do. Okay, so I state what I did right. I state where I didn't follow my plan. I state what caused me not to follow my plan. Then I make the statement that it's unlike me. Okay, then what will I commit to tomorrow to be a disciplined trader in that same situation? Tomorrow I am the stop king. Okay, that's what I'm writing there. Tomorrow I will be the stop king and manage my stops according to my trading plan. Okay, so there it is. There it is. I'm going to give you one last element at the end, but there it is. There is my 4-minute, and sometimes it only takes me 2 minutes if I didn't do anything wrong. Okay, okay, but if you did, and I really try to find something kind of proof. If I even thought about moving my stop, I'll mention it in here. Okay, what did I do? So this day's entry at the end of the day looks like this. It looks like today I took every trade in my trading plan. Okay, today I took every trade in my trading plan. However, I did something unnorman-like, and I moved my stop when I shouldn't have, and took a larger loss than I should have. And it was because some jerk on CNBC made me think that maybe I was making the wrong move. But tomorrow I am the stop king. I will manage my stops exactly according to my trading plan. Okay, that is my total entry. And here is the last line. I am a wise and disciplined trader, and I do the things that a wise and disciplined trader does. That's the moniker around here. That when somebody meets me at what they'll say to me is, I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. Because that statement, I will pound it into myself. I'll pound it into you if you join me. You've got to not only smart is, we're all smart. I mean, look, we're smart enough to believe that, listen, we're all smart enough. You don't have to be a rocket scientist. We're all smart enough to be a successful trader. But it is the wise trader. It is the wise and disciplined trader that will make money. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. Boy, I hope you enjoyed that, because that was a lot of energy from me, because I love talking about journaling. Oh, and did I tell you about what you do in the morning? In the morning, all you do is your journaling is restating what you just, the last part of what you did here. In the morning, I'm going to journal. All I'm saying is, there are 2 sentences. I journal and I say, today I am the stop king. I will follow my trading plan stop scheme like a king. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. That's it. I gave you my afternoon, and I've been doing this for 15 years exactly the same way. Okay, so if you're not journaling, you no longer have an excuse. In fact, what I'm about to give you at the end, there's a bonus in there that that has 97 different ways of journaling. If you don't like my way, if you're a person that wants to journal his trades on your computer, I asked our community, show me how you journal. Well, I got about 170 different. I took what I consider the 97 best, and I put it in a 103-page piece, and you're going to get to download it. Okay, it's on me. So no excuses now for journaling. If you never see me again, journal. You better start journaling. And if you do see me again and you're not journaling, don't come up to me. Okay, at the expo. Your trading plan is your business plan. We went through this. It's all about the bottom line. Control your costs, control your risk. Diversify, I'm not sure. I'd rather do a lot in the right basket and watch that basket. But there's people argue with me on that. Clearly defined procedures. You got to have clearly defined procedures. And I've talked about how you consider a trading. Well, your business, and this is the most important part. Your business is part of your life. It's not your life. Okay, we're traders, but we're husbands. We're wives. We're fathers. We're mothers. But we're not, and yes, we're traders, but that falls underneath there. So don't let trading control your life. Let your trading plan control your trading plan, your trades, and all you got to do is control your trading plan. Once the trades control your life, you're in trouble. When you walk out of your door, if your wife or husband can tell if you had a good or bad day, you're in trouble. Okay, I mean, if it's a really good day, sure, party out. But if it's a bad day and you're moping, and you followed your trading plan, it wasn't a bad day. It was a good plan. It happened to be a losing day. So do not you get what I'm saying. Okay, so here's what I'm giving you today. Okay, I'm giving you 2 weeks of the Disciplined Trader Mastery Program. Okay, and I'm going to and it's got different sections, and because I'm giving it to you, you can take a look. Hopefully I've impressed you enough to say, hey, let's see what Norman's doing in how he's helping traders. And let me see especially what those subconscious trainings look like. But in the basics area, I was training traders to be disciplined, but they had lousy trading plans. I mean, really lousy ones. So I was training them to stick to a trading plan that sucked. So I've I made this basic section in the Disciplined Trader Mastery Program just to make sure that you have a trading plan that at least meets certain requirements. So we ran over a lot of that today. Each one got an hour of my time and an expert with me on each of these management. So you'll really love this section if you need some guidance maybe on risk management or what I meant by trading as a business and so on. So there's a basic section, but the real section is the core modules where we have mental trainings. They're 7 minutes long. You take them before you start trading. They're meditations, okay? And they're not fall asleep meditations. They're sit in your chair, close your eyes meditations, and you're gonna love them. This is the way we build neural pathways to create neural nets that will now control your decision making, a whole nother science that you'll see explanations of if you want to on the site. But pull the trigger without hesitation, overcoming fear and greed. We went through these in the points that may have hurt you before, but now I'm going to help you with these. We have separate core mental trainings. Each one of these areas have a 7-minute or 8-minute mental training that you take in the middle of the day. And you take that training once a day for a 2-week period, even a week period. You're going to start taking your trades without hesitation. You're going to start not being controlled by fear. It's all going to start to turn for you. You're going to have that patience that I talked about. It's all going to start to turn for you. You read about others that have done that. There's a bonus section which includes that 97 different ways to journal. So you no longer have an excuse unless you just want to lose, and you can just go ahead and do that. I say it facetiously, but I really don't mean it facetiously. I tend to joke a little bit too much. You got to journal. You have to do the self-analysis, even if it's in the simple way. I don't like it. When people communicate with me in an email, give me bullet points. Don't give me paragraphs because I won't read them. If you're like that, then you need a journaling plan that a technique that takes you 4 minutes in the afternoon and 2 minutes in the morning. Take mine. I'm giving it to you. I gave it to you. You'll see it again. As one of the bonuses. The bonus, you'll get 90. So if you don't like mine, there's 96 others you can take a look at. They're longer, and you can spend more time, and you can. And some of them are short, but find one in that. And there's all kinds of bonuses. I won't even. I'm not doing this. I'm not a guy that gives you stuff for the bonuses. I mean, the bonuses are, but the 97 thing, I guess I am giving you. I guess I am that guy. There's even a lifestyle section where there's over 100 different meditations on other parts of your life. Remember I said that trading is not your life? People were coming to me, as I mentioned, they come all the time and say, well, I'm not only patient with my trading now, I'm patient with my dog, my pet. Do you have anything for my, can you help me? Can I lose, I gotta be patient. You know, I got to change my eating habits. I got to be a better golfer, a better tennis player. Our company has made has made these meditations, these subconscious trainings for years. We started 25 years ago, and we've made it in all these categories I just said, plus for students, for entrepreneurs, for salespeople. So if your life is other than that, or if you have a child who has trouble with their memory, got a meditation for better memory, and this stuff works. What you put in your mind is what's going to work for you. Okay, so the bonuses, the lifestyle section is the area where you'll see those 100 other meditations. Okay, so I'm giving you that too. You'll have it for 2 weeks, so don't OD on it, and if you want to start paying for it, you can have it after it because it's so cheap, it's crazy. Okay, so there's no reason for you to not have this for life. Like we have a lot of members that just do this for life. Okay, because they know that if they're going to trade, we have members that are already retired or are doing more long-term trading, but and don't require a lot of discipline because they're making decisions on a yearly basis for their portfolios. But they're still a member because they want access to the lifestyle section. So okay, I'm okay with that. 4-minute drills. I've done 203 of them. I've done 208 of them, but we've only posted the first 203. I'll be posting the other 5 that I've done more recently. Most of them were done 4 years ago and back. For about 4 years, every Saturday I came out with a 4-minute drill, just a pump up. If you're not feeling good if somehow you're not energized about your trading, or you start having self-doubts about, am I a good, is this thing for me or not? I mean, should I even be a trader? Hit one of these 4-minute drills that we have. There's 203 of them. It's just my face and a green background that just tells you that you can do this, that you can. I'm like the little Tony Robbins of trading. That's what I guess I called myself that in the beginning, and now all my friends call me that because I told them to. But let me pump you up a little bit, and not in a way that say, go get them, just go take a trade. Pump you up in doing it properly, okay? 4-minute drills, they're all there for you, okay? And here's what I'm giving you a 14-day free trial. Just go to thedisciplinetrader.com. I think you can probably even click that link and do it. Go to thedisciplinetrader.com. You got a 14-day free trial. There are 3 ways of doing it. You can go monthly and doubt what I'm saying, pay up the first month, but that's okay. You can do it. Because you get the 14-day free trial with any one of these plans. If you want to take a shot, most people actually do take the year when they take the shot, because if they don't see that it's good for them, why deal? Now you can change plans, which is, you got to send me an email, and you still have to pay for the month that you paid in the beginning or whatever. But we'll get you to the, if you're on the 67 a month, fine. You got to complete that 67. And then from then on in, you'll be on the new plan, whatever it is. But listen, if it feels good to you, if this presentation feels good to you, try the yearly or at least the 6-month. But hey, if you're doubtful about trying it at all, you don't want to commit to that, even if you like it, because after the 14-day, during that 14-day free trial, all you got to do is send me an email, which means just reply to any email I send you. I get them all. Say, hey, get me out of this thing. And I will do it for you. So listen, try the free trial, thedisciplinetrader.com. You get the 14-day free trial. You'll see these choices at the bottom of the sales letter. And I really hope you join me and start to respect yourself as a trader. And that means respecting what's between your ears and understanding that it's not a weakness to want to work on your mental and emotional issues as a trader. You're not weak, you're strong. It means that you recognize the fact that the 90% that are losing are not doing this, and the 10% that are doing this. And it's not about the trading plan, it's about you and the way you handle what's between your ears. And I think I think you know that. I think you're going to see it, and how it works to do that, and how energizing it is to do that if you just take that 14-day free trial. So
thanks for being with us. Good afternoon, good evening, good morning, depending on where you are. My name is Simon Jousef, thetraderinstitute.com. Let me start with one thing very important, please. The previous presenter mentioned something really, really important. He mentioned things about psychology. So to start with, let me introduce you to the website. My website, first of all, is through thetraderinstitute.com. Easily you can access us for free. We have unlimited free trials. Okay, yes, you can join Telegram, you can get signals, you can get invitations, which I will introduce you to that too. But he mentioned something about trading psychology, which actually hit with me. I was planning to start with something else, but I'll start with that. If you click on the education tab on our website, there is a video I want you really to watch today. This video was done, I think, 2013, if I'm not mistaken, by Dr. Kenneth Reed. He came to the room, he came to us, and he did a video, a presentation for us, adult ADD and how it manifests itself in traders. Now, unless you're getting married today, I seriously mean it, you need to watch this video, okay? It's very important. Besides this video, we have other videos too on how to use our methodology. I have a previous presentation that I've done as well, but we will get you to know about our methodology and what we do slowly, okay? So to start with, just to let you know, I started teaching, educating traders back in 2001. In 2004, I held my first live seminar. It was not online, it was like a classroom style session, something like this. Okay? All right, so I started with Forex, but soon after I switched to futures. I added futures actually, but I kept the Forex as well. In 2005, I discovered the importance of the volume inside the market. You know, everybody started with technical analysis, which is basically something that we all started with, and sooner or later we realize it's 50% at best. Technical analysis do not work. They might help you see the market, but technical analysis do not work. I'm not being arrogant about it, really. They don't work unless you understand the volume of the market, the mentality of the market makers. The technical analysis will most likely work against you because market makers know how you think. Same goes with the stop losses. We have a system that we call smart stops, all based on the volume. So I started with the tape. I was able to extract a few information from it, including, end of buying, end of selling, unfinished business, capping, traps, point of control. I also had my first major indicator called price magnet, which is developed recently to the SAL indicator. We call it the attraction level. In 2010 or 2009, I switched from training on a class with a classroom style setup to online due to global demand. And you see, I showed you these pictures. I had this is 2006. I had so this is in Colorado and in Denver a few years ago. I had also a Vegas webinar, a seminar I did. So volume profile is not like market profile, just to be clear. Volume, this is market profile, okay? All numbers which really don't make sense. I don't understand it. None of my members understand. Some of my members probably, but it doesn't work for us. It could work for you, but it doesn't work for us. I tried to actually focus on something easier. Volume profile, not market profile. Volume profile is key to market movement. Okay, this is the one of the main indicators. We have a few indicators that we use, but this is one of the main indicators. And the way it works, okay, is very simple. I will give you an example. Of course, I will hold questions. We can do them later, or I will look at them later. But volume profile works very nicely if you know how to use it. Let me give you an example. I will bring first of all, let me introduce you to the volume profile, our main indicator. The charts here are stopped. There's no connection. I just wanted to make sure that I am focused completely on the presentation. But you see, I look at Bitcoin, which I called it today long in the room. I look at the ES, which is SPX, NASDAQ, which is the NQ, the Russell, which I called short today. 1452 is my target today on the Russell. Dow, gold, copper, silver, oil, and also we have currency pairs, okay? Currency pairs. So, and how the volume profile works, for example, this is NASDAQ, and you see the volume profile on a 120-minute chart. Watch the volume profile on the side. Watch how it actually, you can bring in charts in or candles into the chart, and you see how this volume profile shows up. So it's reading the volume, historical volume within the areas that have been traded. And if you minimize the chart, you see how the volume profile changes. It's reading actually, this is a 2-hour candle or chart, or let's just one candle. So if I do this, the volume profile for one candle is this much. See the top, the bottom, and this much volume profile on the right hand side. I can increase it or thicken it up a little bit so you can see. This is volume profile for one candle. Is this enough for me to understand where the market is going or the direction? Of course not. I have 2 candles, it's still not enough. So you see, the more candles I bring in, the volume is being displayed in the right hand side as a volume profile view. And if you see the volume profile is too big, the view of it, just minimize it. See, just minimize it. You can also sharpen it. This is designed for Sierra charts, okay, etc. You notice with this volume profile, you have different levels. You have green, blue, you have small areas, you have big areas. We call them differently. We call them continuation, rejection. We have knives. Do you see this red here at the bottom? It looks like a big sword or big knife. We have suction tubes. You see, for example, this area here between the blue and the next blue, we call this suction tube. So which means once the market gets into it, it's going to continue. You see arrows. These arrows actually I post them for my members. I would say, for example, and this is just an example, today, and of course when I post my calls or my ideas or my top-down analysis in the market, it's not randomly. I study it, I pick my levels, and I put it on the charts, or sorry, on Telegram for my members to see. And we have channels. We have indices, we have Forex, we have oil, we have gold, Bitcoin, etc. And we have a free channel for anybody to join, which is welcome to TTI. You can join this through our website. It's you join our unlimited trials, free trials. So let me show an example for today. Today, and I'll give you one example for the RTY, which is the Russell. The Russell, today, I mentioned that this is for today. Okay, today, the Russell, earlier. Here. Just give me a second. RTY. Here. RTY. This is today, this morning at 9 a.m. Of course, we start the room at 9 a.m. I said RTY attraction to 1452. So I realized the RTY or the Russell is going down to 1452. Okay, 1452. So I know the target for today. What am I looking for? I'm looking for confirmation. I'm using my volume profile and I'm using the other indicators to get confirmation. And sure enough, I found a trade call today. If you look at my trade call, on the NASDAQ, I called it, it was good, but then it did not continue. It was not bad. So at 9:55, I said RTY possible short. RTY stops at 1470. So I'm calling a short, but first thing I'm mentioning my stop loss. The previous presenter talked about your stop losses. Folks, if you do not know how to come up with stops or where the logical stop is for your trade, you better learn. It's not easy to trade as is. Now you don't know where your stop loss is, or you pick a random stop above the previous candle, above the previous wick, or below the previous wick. It does not work. Okay, you have to know your stops according to the volume, where the market makers can hit it. A lot of you believe in stop loss hunting. It's not, because you don't understand volume, you don't understand market makers thinking, you don't have the tools. You think it's stop loss hunting. No, it's the volume. So I said 1470 is the stop, and I said I shall wait for 68 or 69 level to confirm. So I'm waiting for 1469 to confirm, and sure enough, look at the next. We got the trade in. 70 was the stop, and the profit target is 1452. Okay, so far this is a picture of this morning. So far the market was completely crappy, sorry for my language, but it got to 1458. So we got to this 1458 so far. It's there now. It's at 1458. So it's not far from the profit target if anybody stayed in it. Okay, whether the market is going to go fast into your favor or slow, that is a different issue, right? I mean, we can chase it with a smart stop. And then we continued. First target was taken. We got first target 30 ticks. Okay, so here's what we do. Here's what you need to understand. I call trades for 3 contracts. First target, which is T1, is usually on 2 contracts. So if we get in this example for the RTY, we got 30 ticks on the first target on the first 2, which means we got 60 ticks profit. Okay, we got it in our pocket. And the stop loss could be 30 ticks, 40 ticks, still is not going to hurt us on the runner, but we still move it. But here's how the volume profile works. For example, on this example for the RTY, we have the RTY going up, down, and then I have, all of a sudden I realized the RTY can come back down. It could come back down to a price which is here, which we mentioned today, it's 1452. 1452. It's very possible to come down to it. So I'm looking for a 1452 target. What do I do? Do I take it randomly because it's coming down to it? No. I will let the market, I will let the market give me a confirmation. That's why you see my confirmation. So I would look for my volume profile. So my volume profile on the side is like this. Okay, I'll make it simple for you guys. Okay, and the price is here. This is continuation zone. This is also a continuation zone. This is a continuation zone. And I'm referring to what? I'm referring to, you see these green and red and blue, these are the zones that you need to understand how they work. So if the market is basically sitting here, it's relatively speaking, it's within this continuation zone. So between these continuation zone, we have zones, we call them rejections. Rejection. Now look where the market is. Is this a good trade? I think it's a good trade. I think it's a good trade because we are inside the continuation zone. It might continue down all the way to the bottom of it. And once we break this level, there's a big chance we can get to 1452 on the Russell. Why am I saying that? Because I see it coming down to 1452, according to the bigger view, which I did my top-down analysis first thing in the morning. However, I told my members I need confirmation. So what my confirmation is for the market to go a little bit, maybe if I'm lucky, it will go to the rejection level again. Here, which is around the rejection area, I will see my SAL indicator. SAL indicator is market makers level. They show up when you have heavy volume coming into the trade to your favor. It looks like this. If I go to my, for example, small chart, you see these levels. The market, I mean, the charts are stopped now, so there's no data, but they look like this. Pink lines or magenta lines, they will flash or they will show up. So once these show up, I'm calling the trade short, and I already decided where my stop loss is. Why my stop loss is, folks, why is my stop loss here at the burgundy line? Why is it not at green? Do you know why? Because of the burgundy hits, the green is also prone to be hit. Why? Because it's inside one continuation zone. Do you get it, folks? That's why my stop loss usually are very small. And if the stop loss is big, I tell my members, the stop loss is bigger than my liking, you can treat it as such. And I will show you a call I made, recent call, which went for maybe 300-400 ticks on the NASDAQ just 2 days ago. Okay, so I called the trade, and first target is maybe I would see something here in terms of market's rejection, in terms of market makers giving me some kind of indication that this might not continue, or it's going to be some kind of a hiccup against us. So I tell my members, take first target here. And that's exactly what I did when I told my members today, take first target at 64, T1 at 64, 9:57 a.m. So the not only the Telegram has given us a view and the entry price, the stop loss price, and the targets, but also giving me the timestamp. So if you miss it, or if you're new, you go back and look at your charts versus the timing, and you will see how the trade went. Okay, so we got first target And now we're waiting for the last target. Some people got out, some people stayed, some people, because it was since 9 a.m. folks, it's now almost 1 o'clock. It's been going. It's very slow. So now we are here where we stand now. I'm looking at my side computer and I'm seeing the RTY, the Russell chart. They are very close to 1452. We are sitting at 1458 or 1459. You guys can look at your chart, you will see. So that is the idea behind trading. You know your stop loss, so basically you anticipate the market. So I anticipated the short today on RTY. I also anticipated the short on NASDAQ, by the way, okay? Because of the levels that I was seeing. Anticipate. And then you confirm. You confirm. I told you already with what do we confirm with? It's a system. You're welcome to see it. Just go to the website, sign up. You don't have to give us an email or a name, folks. Believe me. Just go in and access Telegram. If you don't have Telegram, you need to install it on your phone. It's a free app, and you can also have it on your desktop. Okay, this is how you're gonna communicate with us. This is how you're gonna receive our signals and see what we do and learn. There's a lot of free education. You can join our free trials. So the last thing is execution. The previous presenter also talked about execution. Anticipate, confirm, execute. When you have a system like this telling you what the market makers are intending to do, okay, your 80% of psychological issue is gone, because the market makers are telling you this is what we want to do. This is their intention ahead of time. And when the market is completely foggy, it means there's nothing happening. Just let that instrument go. So ACE is the methodology. We call it anticipate, confirm, execute. Okay, this is not ACE Trading or ACE website. This is the traderinstitute.com. The ACE method, it's been with me. I've been teaching it since 2004. The ACE, anticipate, confirm, execute. Okay, let's go back and let's see what else do we do. So this is the website. Okay, you go on and do your free access. Go, click here and open with Telegram, and you will automatically be joining. You will be joining this room. Welcome to TTI. I have 4,100 over 4,100 subscribers now. So just subscribe like them. Nobody will ask you for a name or email or anything. Just log in and join, and you will have us on your phone or on your desktop, and you can join us. You can contact me, contact Daryl for trials. Okay. So this is the website. As I said, you can get in free trials. The performance, I used to put in performance, but I decided recently, I think towards last year, I decided, you know what, people can come and see 100% whatever they want to see. They will judge. They will stay with us for a month or 3 weeks, and they can come into the room, come into the other channels of Telegram. They will see for themselves. It's about the approach that I'm presenting. Besides my trade calls have been yielding 1,000 ticks or more a month. Last month we had, I think, over 4,000 ticks in trade calls that I gave to my members. And a person was saying, I was talking to a person, he was saying it's hard to believe. Well, you think it's hard to believe? It is very amazing to get 4,000 ticks in your favor called swing. I do swing trading. I call swing trades. You go in and look at your Telegram and look at all the calls I made and mark them against your charts, and you will see massive moves. It's logged into the Telegram, so really it's there. Okay, so you get, as I said, you get free education. You get a lot of videos. So let's go back. I forgot. Let's go back to the performance. The reason why I don't like performance anymore, folks, I call trades on indices, futures market. I call trades on CFDs, which are the spot, the Forex version of the futures market. For example, NAS 100 is NASDAQ, but it's treated as spot market. Okay, it's not futures, it's Forex. I do gold. copper, as you see. I do currencies. Let me show you. On 2 days ago, I called a trade. Here, July 14th. See the time, the date, the time was 9:25 a.m. 51 people saw it because I have on this channel I have 98 members only, but 51 of them, you see, saw it, and it says Canadian Swiss franc long at market or better, stops at this price. And I gave them a snapshot, and I gave them the level where the stop loss should be. And you see this magenta line? Folk, I hope you see it. This is a very small magenta line that showed up, but this was my confirmation. And I told them my first target, okay, first target is this, and my last target is the blue line. You see this, the blue line? Look what happened. First target is, I said, is out. You see the first target is out. First target was about 60 pips or so. 60 pips. And look at last target. I said Canadian Swiss franc move stop loss to +10. So we are moving our runner stop loss to +10 pips. You lock in 10 pips. Why? I want to give it room. It has to be a smart level. Not up to me. It's up to the volume, what the volume is giving me. Okay? We are 70 pips in the move now. And look at for last target. This last target was hit. Okay, and it actually exceeded the last target. So I also do Forex, folks. And if you cannot trade Forex in the spot market, you can trade the standard currencies in the futures market. For example, USD CAD. I'm looking for a USD CAD long, which means if you're trading the CAD in the futures market, you're looking for a short. And I told them I'm looking for a long from this area. You see, visual. Everything is visual, simple to follow, easy. Okay. About the, what else do we need to talk about? Just give me a second. Let me see what else do I have. I don't usually prepare for webinars. Okay, the other indicators that we have, besides the volume profile, as you see, and the SAL indicator, which is the magenta lines here, the magenta lines, we have something called power lines. Power lines, as you see, these lines are not trend lines, but they are, we call them power lines because simply they are connecting levels that I chose, and they present a huge amount of resistance and support. And you can, of course, all the indicators that we have, folks, if you go to studies, they are designed for Sierra charts. You see all of them, you can manipulate them according to what you want. For example, Simon's attraction level, SAL, you can pick one level or you can pick 10 levels or 50 levels. Don Chain channel is standard, it's not mine. It's standard on Sierra charts, it's standard on most platforms. Volume profile, it's ours. It's you can choose to get your own volume profile from Sierra chart, which is basic, but we have our own. It's very dynamic. We have DRL, dynamic reversal level. You see this on the side. I will show you. I will just reduce my volume profile so you can see those lines coming out of the side right here. 1440 minutes, which is the daily, and then 240 minutes, 220 minutes, and 180 minutes. These are dynamic reversal levels. This is an indicator that gives you levels on the charts that are very prone to reverse. However, folks, you have to understand, it's not enough for me to see this level hits. It's not enough. It's not enough for me to see a power line hit. I have to anticipate, I have to confirm, and then I have to execute. I'm also patient. The previous presenter mentioned about patience. Patience is key. Why? Because I try and since I'm looking at maybe 10, 15, 20 different instruments, why do I rush to call? I'm waiting for the mature trade, a trade that is matured and ready and prime for me to call for my members. Therefore, whether you believe it or not, most my trades go in favor, even if they don't continue due to certain things. For example, today, my first call on the NASDAQ, it did go in your favor. And I warned everybody. I said, I'm calling this trade at 9 a.m. I don't like 9 a.m. trading, especially for swing trading. I like 9:30 swing trading and 10:30 a.m. Eastern swing trading. 9 o'clock, they all know. My students have been with me, some of them 10 years, 5 years, 7 years, 8 years. They know 9 o'clock is not for me. 9 o'clock, I do my top-down analysis. But the trade presented itself. I called it. I said it's 60% trade. We took it. It went in favor. But as soon as 9:30 hit, it went up and took the stop loss. But still was a profitable trade if you managed it correctly. And then the Russell came after. The Russell it did go back and forth. I think the Russell, some of people moved their stops and got stopped out on the runner. Still, first target was 30 ticks on the 2 contracts, but I'm looking at 1452 on the Russell. So these are the indicators, and we have a few more, but main indication, folks, is your volume profile and your SAL indicator. You can use on the Forex and in the futures, okay? And you can use it on CFDs. You can use the same methodology for also doing options long term, okay? For example, nat gas, I'm waiting for the nat gas to come down to this level for me to call it long. And if it doesn't come there, I'm not gonna call it. You know, I have an audio alert. It will give me an audio alert once I get there. So in terms of offers, folks, I really don't have. We have what do you call it? A membership program. It's once you pay once. It's unlimited program. It's comprehensive. You don't have to pay again. But you have to deal with our sales manager, because he might give you something that's suitable for your situation. He might offer you a payment plan. You talk to him, you know, but not before you come into the trials. We offer unlimited trials, folks. So please join us, come to the trials, and learn. And learn how amazing this is. You know, it's up to you. Nobody will force you to do anything. Nobody will force you to join. And you know, ask our members too. Join and ask our members. We have twice a week live room. All members can see each other. I'm planning to maybe increase it after September, after the summer is over, to maybe 3 days a week. But majority of the business happens on these channels, which we have: Bitcoin, gold, oil. This is the free channel where you have to join if you want to. Forex, and this is elite. You see, we have some elite members. All the students chat here. You see, this is not me. This is not only me. This is all of us. Members chat here, and they present their levels too. Use, for example, this person, Gary, he mentioned he's looking for possible short on copper, and he was looking for possible short on ES, okay? And you can also do the same. What else do I have? So I will show you another example that happened yesterday. I don't think I had a comprehensive or a trade call yesterday, but on July 14th, I will give you another example for a trade call. You see, I said NAS or NQ, NASDAQ. I'll show you. I show you, just wait. Okay. This was earlier in the day and the previous evening. I mentioned to my members NASDAQ NQ down possible to 10,400. So I told my members, folks, NASDAQ is going down to 10,400. Watch this. This is the NASDAQ. This is 10,400. And this was the view yesterday. This is when I said it's going to come back down to 10,400 right here. Okay? So far, so good. Did I call a trade? I didn't call a trade. I also said 10,200 possible for the CFDs, because CFDs and they move the same way, but a little bit of a different tick value. And then I mentioned the Dow. I do my top-down analysis, etc. But at one point, folks, I saw the entry on the NASDAQ. Look, NASDAQ short, stop loss at 10,600. So I was calling the short immediately with the stop loss defined. So I said short, so which means market or better. Sometimes I'm able to also give you the exact price or better, but market or better. I said T1 at 1070. So I'm looking at a 40, 50, 60 ticks first target, and we got it to 570, which because I made a typo mistake, immediately I fixed it. And then I said move stop loss to 80, so lower. And I said we're gonna get 10,400. We're gonna get it. I said NASDAQ target 140, and we moved, continued until what? Sorry, that was long, not short. That was long. I'm sorry. My mistake. It was I called it long. I'm sorry. So we called it, and then I'm sorry. 10. Let me go back. 10,400 hit, and I called it long from there. You get it? So I called it long. I made a mistake. It's there anyway. So at one point, folks, I said NASDAQ moved 300 points from 10,400 support. You see, from 10,400, it moved 300 ticks and more. So these are my swing trades. It's exactly the entry, the exact level, the exact target, first target, and moving your stops. Okay. So now I think I have 10 minutes. If anybody has questions, please let me know. Let me look at questions. Where's the questions tab? I'm looking at it here. How to join a volume profile? You can simply go to our website. Dimitri, can you give them the website, please, to everybody? You go to the website, folks. I'll show you. traderinstitute.com. Thanks, Edwin. And you go to free access. Very simple, unlimited. Okay. NASDAQ is $5 on the futures, but you can trade it as much as you want or for how much you want. Telegram, yes, join me on Telegram, please. And you can get any, anytime you can access the rest of the channels. You just ask for them, because we do have, when you access Telegram here. You need, first of all, to install it. To install it on your phone. And also, if you don't want to do that, you can just put it on your desktop. And we have Telegram for desktop. It's very simple. It's doesn't have to be on your phone. So see, this one here is Telegram for desktop. You can have it. You can install. You can see it. And then once you access that, folks, you can access the rest of the. You can ask us. You can basically private message me or private message Daryl here. You can private message Daryl. Daryl is our sales manager. You can see the amount of private messages we get sometimes, depends. Okay. And you can access, you can ask for, come into the room. We have a live session. Now, one other thing I want you, or a few more things I want you to pay attention to, our YouTube channel. It has a ton of videos about our live calls. Okay, we do have a lot of calls. I do calls and I video them. Basically to show you how you do and how we do it. And this is it, folks. If Dimitri has it, he will give it to you as a PDF file to everybody. And basically, I don't want to sell anything today. I don't want to do other than, introduce you to myself, introduce you to my website. Funding, if you want to get funded, you can just click here and go participate with either Gauntlet guys or Top Step Trader guys. You want to learn about our methodology, go to the education section. It is vital, folks, to anticipate the market's move. It's vital. If you don't anticipate the market's move, please, there's nothing there for you. Anticipate, confirm, execute. Anticipate each move. I have members here with me today, and they know. If I don't anticipate the move, I tell them I have nothing today. And you see that I anticipated the RTY, the Russell, to go to 1453, 1452 today, right? Where is it now? I'm looking at RTY on the side. Yeah, it's just 14.55. So it's about 3 points. 3 points away from the last target that I was anticipating to, and we still have time. It's only what 1:10 p.m. So we still have a lot of time. Okay. That's it. If you have folks questions, let me know. I will be able to answer them. But again, anticipate, confirm, execute each trade. Confirmation is key. Watch these videos. I have a similar video to the one that I told you to watch. I mentioned to you. There's another video similar to it by the same doctor called Dr. Kenneth Reed. Okay, the one mistake all losing traders make and how to avoid it. Again, these two videos, flicks, this one and the previous one with the man of the head of a man. Believe me, unless you're getting married today, you need to watch it, please. And with that, folks, I am done. And I appreciate your time. Thank you so much. I don't want to take more time because I think there's another presenter coming up. Anna, thank you. Thanks, everybody. All the best.
All right, so good. I'm ready to rock and roll. So thank you for inviting me to the presentation. Sorry for the little delay there, but well, I guess it was a good thing that we're able to start a little bit earlier. So today I'm going to show how to trade pure price action. And just a little bit about myself. I'm the author of Trend Trading for Dummies. I'm Barry Burns, owner and founder of TopDogTrading.com. And I received Reader's Choice Awards year after year from Stocks and Commodities Magazine for my website, my trading courses. I have helped other authors write their books as well, done contributions for their books, worked with major companies. Here's just a few of them. I'm not going to talk about it myself a lot, but just so you know that been around a little bit and been vetted by a lot of big organizations. Also have a lot of free content that I put out there for traders. One of them is in my podcast. Another one is my YouTube videos. Got over 250 YouTube videos out there now. You can just go to YouTube, type in Top Dog Trading, and you'll find my channel that way, or go to iTunes, Stitcher, Spotify, wherever podcasts are, you'll see my podcasts. Here's our important disclaimer. Got to make our lawyers happy, obviously. And but it's not just that. I like to just add this little thing here. I'm not going to read through all this thing, but I encourage you to, because these legal disclaimers, we kind of dismiss them thinking, oh, it's just legalese. Well, it's more than that. The regulators have actually done some research and they have found what are the biggest mistakes traders make. We all know that most people lose money trading. And the regulators have actually done us a favor by going out, researching, and finding out why most people lose money trading. And if you read these disclaimers, it's actually educational. They're telling you why most people lose money, what doesn't work. So highly encourage you to actually, read through all of those. Go to Top Dog Trading or any trading website. We all have them, and read through the details of that. Okay, so let's get to the price action, and let's teach you some really, really, really practical stuff. So today, what I'm going to do is kind of go through 3 levels of teaching about price action. So we'll start with 101. So people who aren't very familiar with reading price action at all, we'll cover a few things here real quick. Then we'll go to the intermediate level, and that's where we start putting price patterns together. And then we'll get to some advanced stuff. And this is the stuff that doesn't even show up on your charts, but is still very important for price action. All right, so I think everyone's going to learn something new here today. All right, so price bar. Well, first of all, for those of us who are traders, of course, that's a price bar. And so this is just reading one price bar. And so I'm going to use candlesticks here today because I use candlesticks. Most people seem to these days. So there's 2 issues of primary importance when reading any candlestick bar. And that is this. I'm not going to go through all the candlestick patterns and their Japanese names and all of that. That's not what I'm going to do today. I'm going to talk about the logic of the bars. So 2 main elements in any bar is the range of the bar from low to high, and then what's called the real body, and that's the colored part of it. All right? So in this case, when it's green, that means it opened here at the low of the real body, the thicker area of the candle, and it closed up here. That's also a wide range bar from low to high, as well as from open to close. So therefore, we consider that a bullish bar. It's a very strong bullish move within one bar. So the converse of that would be a very bearish bar. Again, wide range from high to low, and also open near the high. Because it's red, that means it closed down here. So red means it closed below the open. Green means it closed above the open. So that's a one bar, very, very bearish bar. Now, this is the other type of bar that I really like to read. So again, wide range from high to low. But here the distinction is the real body, the colored part of the bar, very narrow range. Now, for me, whether it's red or green, when it's this narrow range, doesn't matter. And this is where a lot of people get a little confused or a little put off because they get so enamored with red and green, red being bearish, green being bullish, that they put too much emphasis on that. So when you get those wide range real bodies, then yes, the color is important. When you get narrow range real bodies, the markets are not that precise. They are a little noisy, if you will. And so the narrow range real body, the color doesn't really matter. It's a real narrow range like this. What does matter is this. From these price levels, from that low to that high, after all was said and done during this time period, and this applies to any time period bar, whether it's a daily bar, a 1 minute bar, a 60-minute bar, anything in between. So during this period of time, the market got buys and sells all through these prices, but these higher prices, by the time everything was said and done during the time of that bar, these higher prices were rejected. So this type of bar called a rejection of value bar. That's a term borrowed from Market Profile. And they don't use candlestick bars in Market Profile, but the concept is really, really valuable. And so I use the same term with candlesticks. So it means, again, that while all was said and done, buying and selling went here, after all was done, the market participants said, nope, we are not paying these higher prices. We believe the value of this market, Forex pairs, futures, stocks, whatever, it's worth less. Therefore, this is a bearish bar. The high prices were rejected. Conversely, this is a bullish bar. Now, I intentionally used a red bar, red real body for this, again, to make the point that even though it's red, it's still bullish because it rejected the lower prices. And since all these lower prices were rejected during that time, the market found the value of this market up here, and therefore we would consider that to be a one bar bullish bar. Okay, so again, this is the basic stuff before we get to the intermediate. So now two bar logic, because one bar doesn't really mean that much. So two bars, now it adds a little more value in reading two bars together. So in this case, we had one bearish bar immediately followed by one bullish bar. So the two bar logic of this is we had a reversal, whether it's a day, if this is one day and that's the next day, that means that overnight, the market participants changed their mind. Imagine that. Traders changing their mind. Unheard of. Well, it happened. And it happens a lot. Or it could be between minutes or between hours or whatever. So this bar invalidates that bar. In other words, the green bar invalidates the red bar. Markets are changing their minds all the time. The sentiment is changing constantly. And that's why markets move. Otherwise, they wouldn't move. Same thing here, except the opposite. So we had a bullish bar, and then the next bar is very bearish, wide range. Remember, two primary qualifications: wide range bar, wide range real body. Therefore, that is a very bearish bar. Invalidates the bar before it. So you're looking at this bar in real time and say, oh, it's bullish. And then the next one comes along. Whoops, nope, completely the opposite now. Markets have turned around. Now, what is this two bar price logic? So the first two, I think, pretty intuitive. This one, little extra step here. We already covered the one bar logic of this pattern, and we said that's bearish. So this again would be a reversal of sentiment, bullish to bearish sentiment. Market rejected these higher prices. We had a bullish bar here. Market tried all of these prices to try to go up. And then after all was said and done, all the participants around the world decided, nah, you know what? Changed our mind. Bearish. This one, 2-bar bullish pattern. Again, the logic is bearish bar, and then switches, rejects those lower prices. It says, nah, you know, we think this market's worth more than that, and it closes up here. Okay, and then this is just neutral. 2-bar logic's just neutral. So what we have here is bullish bar. Next bar is a neutral bar. So again, our two criteria: narrow range from high to low, narrow range in the real body. Therefore, that's a neutral bar. I don't give a mouse's left patootie if that is green or red or black or blue. It's a narrow range bar, therefore it fits within the signal noise ratio of the market action. And so the 2-bar logic of that would be actually bullish, because the first bar is bullish, the second bar is neutral, therefore the sentiment has not changed. So we're still bullish. All right, now let's start putting it together. All right, so now let's get to the intermediate level here. So in the intermediate level, we're going to be putting together more than just 1 or 2 bars. So here we go. And now I want you to participate. We're here live. There's a ton of you here. And so I'm live, you're live. Let's talk back and forth a little bit. I find that people learn a lot by participating and not just sitting back and listening. Okay. By the way, I forgot to mention, I don't have anything for sale today. I kind of dropped the ball. So I hope you guys don't mind, but yeah, I did drop the ball. I didn't bring anything for sale. Don't be mad at me. I know you guys are really upset now. What, Barry? We only come here so you can sell me stuff. I got nothing to sell you. All I have is free education for you today. Hope you don't mind. Okay. Anyway, and part of it will be during this presentation, obviously, right now. And then at the end, I'll just give you one of my courses for free. How's that? I mean, that's pretty good, right? Because that's what I came with. All right. So anyway, having said that, now here's the idea. So let's just look. We're not going to look at every one of these dots. Well, I'll look at them, but I want you to participate with me on this one. So on this arrow here, here's the question. I used the word validate or invalidate earlier. So on this green bar, does this green bar validate or invalidate the price action of the bar that precedes it here? So go ahead and type that in. You cannot hide from the market. The market will track you down. So might as well do this while there's no money at stake. And let's learn a little bit. So go ahead, type in validate. In other words, validate would mean we got red bars, so it means we're still bearish. Invalidate would mean, oops, nope, now we're bullish. Or neutral, you can put down neutral if you want to as well. So let's see what we got here. Edwin, good. Carlos, awesome. Appreciate you guys participating, by the way. Solanco, excellent. All right, come on, people. We want to see some interaction here. Let's go. Oh, there we go. Rajesh Mrathod. Sorry if I mispronounced your name. I apologize for that. Neutral, loose, invalidate, trader, neutral. Trader. Is that the name on your birth certificate? I'm kind of not sure. Steve, neutral. That's okay. I know what you mean, brother. Very good. You guys did great, by the way. Okay, so it is neutral. Very good. It is totally neutral. Muy bien. I can't even speak my Spanish today. Ausgezeichnet. I'll go with German. So you are correct. If you said neutral, you are right. And I got to tell you, I got to give you guys a little props here, because you are the only group that I've ever done this presentation for where the vast majority of people said neutral. Seriously, you really are. You're the only group that the majority has said neutral. It's always happened before that people have said it invalidates because they have the forward-looking bias. And that was the point I was going to make, but I don't have to make it because you guys already got this thing figured out. You guys are smart. So yes, the problem with, and this is making a second point here, when we analyze historical charts and we can see what happened afterwards, we get what's called a forward-looking bias. And so we can misinterpret signals that then we use to trade with. Now, you guys didn't fall victim to that, so I got to give you credit. That is just a neutral bar. So my second point on this is that not every swing high or low gives you a high probability trade setup. So that's a very important thing to know. People will come and say, well, how could I have known this would have gone up? Or how could I have known on this other chart that this would have gone down? And sometimes I can tell them. And most of the time, though, I have to tell them, you know what? There was no way to know. There was no high probability trade scenario there. And so you wouldn't have known. So that's a place where we just wouldn't take a trade. Sure, the market went up, but who cares? Market goes down, I didn't take the trade. Don't feel bad about that. Don't have what we call traders regret, where the market moved and you didn't get in and you feel bad. There's no reason to feel bad about that unless there was a really high probability trade setup. And at most swing highs and lows, there isn't. The market's going to do all kinds of stuff, and it doesn't mean you should have known what it was going to do. So good, you guys got some rock stars here today. Okay, so I'll just do the other ones here for you. So this one invalidates the bar before it, because now this one is a wide range bar and a engulfing real body, red. This one is basically kind of neutral, so our sentiment remains bearish. This one invalidates the pattern before it, wide range bar, wide range real body, it's green, closed way up here. And so, you know, some of these do give us high probability swing highs and lows. That one did not. That one did not. All right, you guys impressing me here today. All right, well, since you're so smart, let's see if you can figure out this one. So now there's no opportunity for forward-looking bias. So based on this price formation, hard red edge of the screen, now the arrow's over here. So type in, what would you expect to happen next based on the price bar formation? And that's all I'm going to say. I'm not going to give you any more clues. You type in, what would you expect to happen from here on out, given that this is the right edge of the screen? So let's see. Oops, I got to scroll down. Okay, that's why I'm not seeing any answers. I hadn't scrolled down all the way. Okay, so Solanki says going up. Edwin says bullish. Ooh, not too much confidence, but I appreciate you putting it in. Solanki, yep. Rushing, when, good. So Steve, Noel, Dominique, oh, now we're getting more people participating. Awesome. So JP, good. So yeah, so here's the dealio. So we've got a gap. That was probably obvious to everybody. So again, what we want to do is, now I did put in the question, what would you expect to happen next? The next level question, if you were a student of mine, I would ask this question, but then I would also say, why? I would ask you, and why do you expect that to happen? Because when you go to trade, you've got to have a reason why you think something's going to happen. Every trade you take better be based on some sort of logic, right? So the answer to why here, and that's where we get into more advanced stuff is, so we gap down one day, sideways movement, oops, bearish bar, okay, and then we kind of mess around here for a little while, then wide range bar from high to low, narrow range real body. That means a rejection of value of the low prices. Notice it also came back down to this low. So it's retesting the low of the day so far. And this is about an hour into the day. And rejected that low. So sometimes gaps will close and sometimes gaps will, what they say, gap and go. Gap and then continue to go in that direction. So you're right. I would expect this to close. I would expect this gap to close. What's going on here? There it is. And the reason I would expect it to close this time is because of this retesting these lows, rejecting those lows as evidenced by the real body being way up here. And that's exactly what it does. Okay, awesome. Now, from here, what would we expect to happen? Well, again, just to speed things up a little bit, since how we doing here? I got 25 minutes, I believe. So market comes up, 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 boom. Comes back down, retest this high. Now, again, important to understand that we need to account for the noise in the market. So this high, that is the high, but if I'm going to draw a resistance level, I wouldn't draw it off of that high. I would draw it off of these real bodies. And the reason I draw up support resistance off of real bodies is because that's where, you had some significant action. This is just extreme. And we can't expect the market to always get to the extreme high or the extreme low again. So it's safer to draw it, and support resistance are not really lines anyway. We draw them as lines, but in real life, they're actually kind of zones. And so we come up here, we retest this, we get a nice engulfing bearish pattern, and down she goes. Double top confirmed by a red bar that completely negates the construction of the green bar. All right. Now, I'll do this one as a quiz. That one I did for you. What will happen next and why? We're on the hard red edge of the screen. There's our arrow. Here's the market right now at this snapshot in time. Time for you to make a decision. Do you want to trade? Not trade. If you do want to trade, do you want to buy? Do you want to sell? So go ahead and type in your answers and let's see what you got to say. Okay, let's see here. Yeah, Dominique is asking whether it matters if it's a 1 minute bar, 5 minute bar. The price logic does remain the same. That's a good question. The price logic remains the same, but it's just for a different scale. Now, that's an excellent question. So the other aspect of answering that question is, what is the average daily volume of that market? So if you've got a market that's very thinly traded and you're trading 1 minute bars, the bar patterns are not going to be that significant. Right, but if you're trading something like the E-minis or something that has really, really, big volume, then yeah, a 1 minute bar would still be significant for that time frame. So relative, it would still have short-term significance, right? But it would have significance in the short term. Great question. Okay, thank you, Edwin, Trader, Suravan, Solanki, Rajesh, Mario, Dominique, Solanki, Trader, Steve, Wen. Okay, so here's the dealio on this one. Whoops, keep going backwards. Okay, so this is where we were. This is the bar that I showed on the hard red edge of the screen right there. Now, what wasn't maybe obvious at first, I'm going to go back a slide intentionally now, is that now we're introducing a new element to the chart. Resistance. So it's now we're saying not just the bar pattern, but now we're adding to it. As I said, we continue to evolve, start with simple stuff and then add more and more to make it more intermediate and eventually advanced. So we've got resistance levels here. So there's two highs, swing high, swing high. So connect those two and look, it splits this bar. The resistance goes right through that bar and we close above the resistance. So if I go back now to the next slide, you'll see it. So that is the dollars that are in the details on that pattern. So that bar that we were looking at on the hard red edge of the screen is here. And you can see it closed above that resistance, sliced through it. And so that gives it an even more bullish sentiment. So we got your wide range, we've got your wide from high to low, we got your wide range real body, closes near the high and above resistance. Now you might think, well, just because it's a wide range bar, it should work anyway, but no. Here's an example of where we had an almost about the same pattern, except it's red. right? Open high, close near the low, wide range real body. But there's your support level. And it didn't close below support, it closed at support. And therefore, that is an indication that, people did, they were kind of bearish here, big bearishness just to get to that level. And then they're stopped like, oh, no, put on the brakes, not sure, don't feel confident with that this is going to go any lower because last time we got to this price level, people bought. And that's really the thinking or the logic behind support resistance levels. It's a mass psychology dynamic where people are looking at a chart and they're saying, the last time we got to this price level, people bought. The last time we got to this price level, people took profits or sold. And so the mass psychology kicks in. But obviously, markets are dynamic. Markets change their mind, change their sentiment. Could be rumor, gossip, news, fake news, whatever. And, as time goes by, all of a sudden they say, you know what, we don't care anymore about this price level. Now, some new piece of news came out, and so therefore we're bullish anyway. So now let's talk about volume logic. All righty. So we've talked about price action, but I always like to use volume in conjunction with price. So we talked about 1-bar patterns, 2-bar patterns, multi-bar patterns with support and resistance. Now we're going to add one more element, and that is volume. So there's a distinction in volume between large volume and small volume. So this is where, again, dollars are in the details. We want enough volume to bring strength into a movement, but not too much, because if you get too much volume, it's usually an exhaustion pattern. It's usually the end of a movement. And we want not just large volume, but we want smart volume. So not all volume is created equal, right? You can have a lot of volume coming to the market, but it's just retail traders. And we all know that roughly 80% people lose money trading. So if it's the people who are coming in on that trade or during that period of time are the 80%ers, then think of that. The volume would actually be a counter indication. You should not follow that volume. You should actually fade that volume, because the probability is they're probably going to be wrong. So we want to know, well, is it retail volume or is it professional participation, professional volume, institutions, the smart money, the 20%ers? That is huge. That is a huge distinction. So just reading the volume histogram on the bottom of your chart, yes, that has value, but let's take it a level beyond that now. All right, so here's how you do that. You don't even, well, you can kind of do this on charts sometimes if you have the right tools, but here's essentially how it's normally done with professional trading. So this is called a time and sales window, not to be confused with level 2 or level 3. So time and sales window, let's see, we got a TradeStation version of it here. And so you can go to your trading platform and ask them, if you don't already know, hey, do you guys offer a time and sales window? Most trading platforms do. And maybe you just don't know it's there. If you do, great. But then also go into their tutorials on how to use it, because here's how I use it. The default will probably show you all the bids and the asks and the buys and the sells here. So this column right here in TradeStation is called type. They'll show you everything by default. Bids and asks and buys and sells. I don't want to see everything. Okay, so I customize this, and you can go in and edit it and just uncheck boxes. So I uncheck the bid and the ask. I uncheck everything except trades. And the reason I do that is because, well, as we know, actions speak louder than words, right? So a trade is an executed trade, meaning that whoever made these trades, money is leaving their account. That's action. That's commitment. That's not a date with, for a cup of coffee or a glass of wine. that is marriage. Okay, they're married to that position. That is a commitment. And people are very serious about their money. Now, if it's just a bid or an ask, there's no commitment there. That's talk. That's just talk. Because as the market approaches the price of their bid or their ask, they can pull that bid or that ask. So there's no commitment. So I don't take that stuff seriously, because they could just, well, they could pull it. Now, does that happen all the time? Of course not. Does it happen sometime? Yeah. So for me and for my house, I'd rather just look at where I know people are really, 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 really committed. Now, I do know traders who include the bid in the ask, and they're very good at reading that and do very, very well. It's called tape reading. And I've got one friend especially who does extremely well with that, and he makes a truckload of money. So I'm not discounting it. It's just a little higher level skill. So I eliminate that from my view, and I just look at the actual commitment of traders. Oh, not to be confused with the commitment of traders report, by the way, because this isn't real time. Right? This is happening. I mean, if you pull up a window like this, you're going to see these orders scroll through. And sometimes they'll scroll slow, sometimes they'll scroll fast, depending on how fast orders are going through the market. Okay, so that's the first edit that I do to the window. Of course, you got your timestamps here. And by the way, look how many trades are going through in just seconds. And in 1 second, we've got 4 trades that go through. The next second, another one. Well, there could be more up here. Now, okay, so that's the first edit. Now, oh no, I want to go back and say something else about this. So size is important. So, oh, I didn't realize how that came off. I wasn't trying to make a joke there. What I mean by this is going back to professional versus retail volume. So this is the NQs, NASDAQ 100 futures. So they're leveraged. And so how are we going to track down the amateurs, and how are we going to track down the professionals to find out, is this professional volume or retail volume? Because remember, if it's retail volume, it's probably going to be wrong. We'll probably want to trade the opposite side of them. If it's professional volume, again, not that they're always winners, but more times than not they are, and it'd be smarter to follow them. So what I do is, again, I edit this column. And in this case, I mean, you can play around with the numbers as you want. In this case, it looks like I set it to only showing trades that have 20 or more contracts. So what that means is it will not show me visibly any trades that go through that are traded with just 1 contract, or 2, or 5, or 10, or 19. Okay. And the thinking behind that is, well, probably people who are trading 20 contracts or more, well, actually not probably, they do have pretty decent sized accounts, because otherwise the broker wouldn't allow them to trade 20 contracts, right? They got to have the margin to do that. They've got to have the funds in their account based on margin in order to do that. So they got big accounts. Normally the odds are that most professional traders will have big accounts. Most retail traders will have very small accounts. And especially if they're executing 20 trades, 30 or 20 contracts, 30 contracts, 50 contracts. So it's not only that they have that money in their account, oh, they probably have a lot more in their account if they're good at risk management, because they're probably only risking like 2 or 3% of their whole trading account, and they're trading 50 contracts. So now we're talking about a really sizable account. So this is how I break out, if you will, the professional volume, so that I can see them. Now here in this example, kind of 50-50. So what am I going to do with this data? Nothing. Right now. So that's because that's not what I'm looking for. By the way, little extra freebie tip here. So there's some charting platforms. Yours may have this, yours may not. I don't know. TradeStation does. They call it block volume. It's a block volume indicator, by the way. So yeah, just look in your indicators. It's called block volume. It's not actually down by the volume section. It's under the B's at the top. And what it'll do is you can take this information and you can actually plot it on your chart. And so notice how there's not a volume bar under every price bar. That's because it's only going to show me, well, in this case, 20. So any bar, and I can look right under there. Oh, wait, block trade started coming in at this low. And so the pros started coming in here. Now, retail traders are usually taught to come in the middle of a trade, right, in the middle of a trend. Did the pros do that? No. The pros are always in early, amateurs are always in late, and then more professional volumes coming in here. They're probably now getting out. They're probably now covering their longs, okay, or they're getting out of their positions, selling. Okay, so that's another thing that's pretty cool. If you have it, ask your charting platform if they have it. I don't know which ones do and don't, except for TradeStation, but it's kind of nice because then right on your charts you can see, oh, where are the pros coming in? Now, here's a technique I created, although I don't know, whenever I say I created something, then someone always emails me and says, oh no, Crazy Yeti's House of Trading does that. I'm like, oh, okay. Nothing new under the sun. But anyway, I was never taught this. I just came up with this on my own, not saying nobody else has come up with this. So I like to actually do this. I like to compare side by side the retail versus the professional volume. So as I said in that last example, I wouldn't see anything to do there right now. If I had the block volume under the price bars and I connected that with 1-2 bar price logic, then yes. But as far as just the time and sales window during that, those couple of minutes, no, it was pretty even 50-50. So here's what I look for in order to take a trade. So I'll bring up 2 time and sales windows. One, let's see, this one we set at 10. So I had to have a minimum of 10 contracts, otherwise it won't show up. Okay, most of these are green now. So now it's not 50-50, most are green. And then I'll set up another one. In the other time and sales window, I set it so that a maximum of 2 contracts will show up and nothing more, nothing higher. So this one's showing me only traders who are trading 1 or 2 contracts. This one will show me only traders who are trading 10 or more contracts. Now remember, when I say 10 or more contracts, that's on one trade. That's one executed trade. That doesn't mean they've traded, 1 contract and then 2 contracts and then 3 contracts and then 4 contracts. No, that means 1 executed trade, 10 contracts. That's what that means. So, and look, the prices are the same. 1205.75, 1205.75. Okay, 1205.75. They're all doing the same prices, but the pros, they're buying. The retailers, they're selling. Now, let me ask you another really tough quiz. If you saw this scenario, would you, as a trader, be more inclined to want to buy or to sell this market? Go ahead and type that in. This is not a trick question. Yes, absolutely, right? Pretty intuitive, pretty obvious. Absolutely, 100%. Buy, 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 buy. Yep, buy, buy. Yeah, buy, Mario. Yep, good. Steve, Solanke, Edwin. Yep. Yeah. I mean, this is not rocket surgery. Okay. Once you see it, it's very intuitive. That's like, of course. And it's, yeah. I mean, I don't know what else to say about it. Okay. Oh, I do know something to say about it. Okay, I do have something else. So actually, as soon as I said that, yes, I do. Now, if you want to take this to an even deeper level, and that's not required, but I like to do this. And by the way, I thought I'd show you on a couple of different charting platforms. So this one's on NinjaTrader. NinjaTrader has this too. Most charting platforms do, as I said, but I just thought I'd show you a couple of different examples. So TNS, time and sales. So if you just see TNS and you don't see time and sales, TNS is probably time and sales. So NinjaTrader gives you even some deeper options on doing this. So you can create a color, and I've created mine lime. So green is basically buy, lime is when they buy above the ask. So that's going to show me a very, very aggressive buy, right? They're willing to pay above the ask. And so that shows me more aggressive. Then down here, use a different color for selling below the bid. So I've got my red, and it's just slightly different. You could probably make it even more drastically different, but magenta. So I used magenta for selling below the bid. So again, that's a more aggressive seller. They're willing to get a little bit of slippage there in order to get in. Okay, so that shows a little extra level aggressiveness of buying and selling, that they don't mind getting an extra tick or two of slippage. And then the next level that NinjaTrader allows you to take it to. So here is our size. Let's see, I set this one to a minimum of 20 contracts per trade. And now you'll see we got red, we got green. And as I said, professional traders, they can be wrong. They are wrong. We're wrong sometimes. We got losses. Okay. So they're not always right. Is there a way that we can break this down even further to look for? So we got retail volume, we got professional volume. What about the really big whales? The whales, can we break that down further? And yes, we can. The top tier traders. So there's another column NinjaTrader allows you to use, and yours might too, I don't know. And this is where you can, they call it block trades. And you can set this to whatever you want. So I set it to 50 contracts or more. Now these people have really big accounts, right? Really big. So I'm seeing the guys who are like the mid-tier traders, 20 contracts. But then I'm going to break out from that an even further distinction. Now I want to see the guys who are trading 50 contracts or more per executed trade. And I'll call them block trades. Look, 100 contracts on that one. One trade, 100 contracts. So every block trade is what color? Red. Actually, look, 3 are red, 3 are magenta. So the big traders, they're actually aggressively selling this puppy dog. And that gives me a further distinction of where people, what level of trader is doing the trading on what side of the market. Here's a cool example of how adding these this block volume indicator can work. So again, you look at your price structure. So I always do this. I still look at the charts. I want to make that very clear. I'm not just trading time and sales. So I'm looking at charts. We're stuck between the value area high and yesterday's low here. That's what these lines are. Just channeling along. Blah, da, 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 da. Whoops, breakout. What's the big question everybody has on a breakout trade? Is it going to break out and follow through, or is it going to be a false breakout? Well, there's one way that could maybe help you put the odds on your side. Look for block trades. And there's your block trade indicator. That means the professionals are coming in, they're buying the breakout, and therefore that dramatically increases the odds. It's going to go to the moon, Alice. And it does. So that's what I got for you, my friends. Free education about candlesticks. We started with 1, then 2, multi-bar patterns, adding support resistance to it, adding volume to it, breaking down volume between retailers and professionals, breaking down volume between retailers, professionals, and the big whales, and then adding all of that to chart structure and putting it all together. And it works pretty dang good. And you know what? It's logical, right? And that's the thing. It's not based on back testing. It's not based on my theory or my ideas or my philosophy. It's just logical. It makes sense. And that's how markets work, obviously. So as I said, I got nothing for sale, but I do have a free course for you. So the free course is very, very practical. In fact, in the course, it's so practical, I'm going to give you one of my trade strategies. So you'll come out of this. It's just a mini course. It's 5 videos, 5 little 20-minute videos. But I want you to come out of it making money. So I'm going to give you one of my favorite trade strategies called the rubber band trade. And all the details in there are taught, where to get in, where to get out, the rules, the filters, everything. It's a trade I still take to this day. In fact, I scan for this trade. It's so good. I love this trade. And it has a super high win-loss ratio. So that's why I give it to you, is because I know traders like a super high win ratio. I do. I've been trading for 50 years, believe it or not. But yeah, I have. But I still, to me, and I have friends who have a worse than 50-50 win-loss ratio, and they still make money, and that's awesome because their risk-reward ratio is so good. But psychologically, for me, I just know now I'm not a fit for that type of trading. I need many more winners than losers. This is a high win probability trade. So you get the trade. You get 5 days of video instructions, interactive quizzes, just like I did little quizzes here today. There's quizzes built into the video. Oh, I also do a follow-up webinar. It's recorded, by the way. So there's a follow-up recorded webinar if you want to watch that. It's about an hour long, a little less, maybe 45 minutes, 50 minutes. And in there, I will give you my cycle indicator. And the cycle indicator shows you how to time your entries so you get in at the exact right point so you don't get stepped out so much. So where to get in, where to get out, I mean, that's kind of what trading is all about, isn't it? Where to get in, where to get out. So watch that. It'll show you how to set up the cycle indicator in your chart and how to trade it. All for free. Just go to www.rubberbandtrade.com. My gift to you. And yeah, that'll take you straight to the page to go ahead and register to get everything just right there at that one page. So thank you very much. Appreciate it. And over and out. That's all I've got for you today, my friends. Thank you for being such a great audience.